I think the Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
It feels like global inflationary pressures have the upper hand.
Fed rate hikes just take a really long time to impact the economy.
I just wonder whether we're going to look back and say, we were in a recession. We're already in a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get this week wrapped up and get you to the weekend. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Together this morning with Damien Sassar. TK taking a long weekend. Futures up 0.9% on the S&P. Bramo coming into today, we're down 6% on the S&P 500 this week alone.
We saw the lowest levels going back to 2020, the November of that month. How much have we already baked in recession? We were looking at certain models yesterday that showed that the S&P is pricing in an 85% chance of a recession in the United States in the near term. Okay, so are we there yet?
And more importantly, how much damage is this Fed willing to do?
Yes.
How much damage is this Fed willing to inflict on this economy?
A lot of people are saying that they're willing to cause a recession in order to bring prices down, to bring the pace increases down. It seems like they are committed to that. But as we've been talking about all week, let's see how strong their commitment is when we start to see negative prints on the jobs numbers, when we start to see some of that weakening data filter in, and when we start to question how much some of the tightening is actually bringing prices down, considering where the shocks are coming from.
Starting to see credit breakdown just
Yes.
a little bit. Damien, we talk a lot about this. Are you seeing any sign of stress emerging in this market?
Oh, absolutely, Jonathan. I mean, lack of balance sheet, dealer elasticity is going to be the key risk here now that quant tightening has officially started. So we're completely focused on that. And look, you've got fixed 30-year mortgage rates now pushing up to 6%. Something's going to crack there. It may be triple Bs, it may be private residential MBS, it may be CMBS asset backs, but it looks like it's going to be tough sledding for fixed income investors.
Damon, we've spoken to a lot of people through the year so far who had this big cash position. Does 500 basis points plus on high yield spreads get it done to bring that cash into play?
I'm not so sure. I mean, look, what have we seen in IG spreads? 50 bips. What have we seen? 225 bips in high yield. We're not there yet. We really haven't seen, that real gap widening in spreads yet, in my opinion. I think we need to see that before we really see a market bottom here.
Lisa, we saw that move yesterday, a sizable one.
And a lot of people are saying that they want to move into that higher rated credit because they are starting to get concerned, not about a default cycle necessarily, but a deterioration in credit quality. We still are looking at balance sheets that look pretty good. When you keep talking about that, how far can you go with respect to the sell-off without some sort of liquidity issue? And that, I think, is what people are focused on.
Lisa, you're in for a treat today. We're not going to talk about football, or soccer, as Tom might call it. Damien, you get to choose. You get to do basketball, Damien, or you get to do a little bit of golf going into the weekend.
Oh, I mean, well, I'm not going to ignore golf, but we can't not talk about the NBA Finals. Steph Curry, NBA Finals MVP. I mean, that's his 4th championship. I mean, it's a real dynasty out there in San Francisco, and the Bay Area's got to be thrilled this morning. If anybody's still awake, congratulations.
I imagine they're just going to bed. We're going to squeeze some Rory McIlroy into this show today as well. I can't wait for that. Lisa can't wait either.
Honestly, you come out, you're like,
Do you know how this started?
I have a treat. I have a treat for you.
Before Damien came on air, I went over to him and said, what should we talk about? And he goes, I want to talk about liquidity and credit. I said, no, sport. What do you want to talk about? He said, basketball. So we'll do a little bit more of that later too. Futures up 0.9 on the S&P 500. Here's your price action this Friday on the Nasdaq 100, up a little more than 1%. Equities advancing to close out the week, for now at least. Will this move stick after a brutal week of losses on the S&P coming into Friday at a close on Thursday? Yields higher by about a basis point on a 10-year. We're back to 321 after having a little look at 350, back all the way down into the 320s again. In the FX market, euro-dollar just about holding on to 105 here, Lisa. Euro-dollar negative 0.2%.
And so all eyes do go to Europe with respect to how far they will go, considering the fact that the Bank of Japan seemed to double down overnight, saying, you know what, we're going to keep this peg. And people said, okay, so we're going to sell the yen. Today, 8:30 a.m., President Biden is hosting the Major Economies Forum on Energy and Climate. The reason why I find this particularly interesting is how does he shift his message away from the pure adoption of some of these greener technologies to a recognition of the price of gas, which is the main mode of fossil fuel usage right now in the United States, the main mode that people use to get around. Price is still hovering above $5 a gallon. This is a huge liability for him heading into the midterms, heading into 2024. How does he dovetail this really fragile message? 8:45 a.m., Fed Chair Jay Powell comes back to the podium saying that he's going to talk about the dollar and its role in the international financial markets. This, as the dollar generally has been strengthening pretty steadily to some of the highs that we last saw during the peak of the pandemic. How much does he talk about the transmission mechanism that has and the potential disruptive factor that could play in the global economic recovery? And at 9:15 a.m., we get U.S. May industrial production. How much do we get factory output increasing and factory capacity usage increasing in order to offset the demand? In other words, what happens if we actually get increased supplies, John? Is this issue with inflation a supply-driven issue, a demand-driven issue, a bit of both? What could we do to equalize the supply side in addition to just simply dampening demand?
You know, the stat I saw recently on capacity utilization was on refineries at 94%. Which historically is very high, which kind of pushes back against this idea, Lisa, that the oil players are holding some back.
It also pushes back against the idea that gas prices could come down anytime soon, because if they're actually using them to full capacity, basically, where is the marginal production going to come from when it comes to refining the crude that we get from wherever the supplies are, even if it is from Saudi Arabia?
Lisa, thank you. A bit calmer today after a hectic week so far, up 0.9% on the S&P 500. Joining us now is Eric Robertson, the Global Head of Research at Standard Chartered. Eric, great to catch up, sir, as always. You've had a unique perspective over the last couple of months. You didn't think the Fed would take it this far. You thought they'd go strongly in summer, but ultimately then have to stop because the data was going to weaken. Eric, can you walk me through how your view on that has evolved, particularly after the last Fed meeting?
Yeah, sure, guys. Thanks very much for having me. Look, I think the narrative is still roughly similar to what we've been thinking about for the last couple of months, which is that the combination of Fed rate hikes combined with the other central banks around the world getting on the same bandwagon would lead to a real hit to economic growth in the second half of the year. I think what has probably been a little bit different than we expected is how elevated inflation has been and for how long. And so the Fed is really in this horrible situation where their monetary tightening is going to lead to a fairly negative economic activity environment set against what is still a pretty elevated inflation environment. Now, as we get into sort of the third and the fourth quarters, we think the hit to growth in the U.S. and globally is going to be really pretty profound. And I think that's going to raise some uncomfortable questions for the Fed and probably for other central banks as well.
So what's the trigger, Eric, for them to pivot, for them to perhaps dial back some of their rate-raising expectations?
Yeah, sure, Lisa. Look, everybody likes to talk about the Fed put and how far equities or credit have to fall before the Fed panics. I think in the current economic circumstances, it's not going to be market-driven. I think it's going to be something along the lines of the unemployment rate moving higher and a combination of other job statistics. The reality is we need to see a softening in the labor market to see a softening in wages, and that's going to be a big part of easing inflation expectations. So I don't think the Fed put is the S&P. I think it's the labor market.
Yeah, you know, Eric, everybody and their grandmother has been operating as if the PBOC is going to cut rates eventually. But, you know, we haven't seen that yet, largely because of widening U.S.-China yield differentials. You know, I wonder what your thoughts are there. I mean, clearly the dollar yuan's taken a hit, adding to the risk of capital outflows. But can we expect some monetary stimulus in the months ahead from the PBOC?
Damien, I think that's a really good question, but I think the answer is that it's unlikely. And there's two really important reasons for that. Number one, China historically does not like to be moving rates in the opposite direction of the rest of the world's central banks for exactly the yield differential story that you highlighted. And certainly with the other central banks of the world being so aggressive, I don't think the PBOC wants to be moving in the opposite direction. But the other issue, and this is a bigger picture and perhaps more profound issue, is China has really shifted its stimulus focus away from monetary stimulus to fiscal. And I think that's because they've learned some lessons about the downside effects of excessive leverage. They want to see an economic recovery with stable liquidity, stable leverage in their system. And I think they feel more comfortable directing fiscal stimulus into the economy over the next 6 to 12 months rather than monetary stimulus.
Eric, great points, as always. Interesting perspective. Eric Robson there of Standard Chart. Damien, I don't know if you saw the latest forecast out of Bank of America for China GDP. It has a 3 handle. Oh. It's down from 4.2. It's now 3.5. Yeah. Damien, from the people you speak to, are we ready for that kind of GDP print from the Chinese economy?
You know, I mean, I don't think we are, quite frankly, but that's really where we're headed here. I mean, look, you know, if you just look at the spillover into the broader Asian complex, I mean, Jonathan, that's the real risk. And quite frankly, it all goes back to dollar yen, not dollar yuan, dollar yen, because as that goes down, that's putting pressure on other Asian exporters like the South Korea won, the China yuan. I mean, that's really where the rubber meets the road, in my opinion.
And then everyone starts pushing against the US dollar, trying to depreciate their own currencies. And Lisa, that gets messy quickly.
Especially because how far do they have to go in order to do that? And what does that mean for their growth perspective? I mean, we saw that yesterday with the Bank of England, how their dovish 25 basis point rate hike was received. At the same time, if you do get economic deceleration, how much do you get to a Bridgewater scenario where the dollar does weaken? Let's say that the Fed does go more aggressively. Does that become dollar negative at a certain point because of the pain that needs to be incurred?
What did you make of the BOJ overnight?
Predictable, and also just kind of curious to me because it really raises the threshold for them to pivot, and they're going to have to, right? I mean, did you see the positioning overnight? It was the highest level since 2013. People were betting against JGBs. I mean, they were trying to basically say, stop it, guys. This isn't going to work.
How many JGBs are they willing to own, Damien? That's what I'm trying to work out. How far are they willing to take this? Most people assume they're going to nationalise the bond market. Most people say, that I speak to anyway, that it's not much of a market anyway and that it's already been nationalised.
It's already been nationalised, yeah.
It's a centrally planned government bond market in Japan and seemingly no willingness to turn away from doing that anytime soon. Italy in the mix on that front too. We'll talk about that in a moment. Coming up in the next hour, Victoria Fernandez, Chief Market Strategist at Crossmark Capital. We'll catch up with her at around 7 a.m. Eastern Time. Futures right now, you're waking up to a little bit of a bounce, up 0.9% on the S&P 500 this morning. Good morning to you all. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. Russia's invasion of Ukraine caused one of the fastest and largest displacements of people since World War II and helped push the number forced to flee their homes globally to the highest annual level since the United Nations began keeping track. The UN Refugee Agency said today the number of people displaced around the world tops 100 million, and the war in Ukraine has displaced about 8 million people within that country so far in 2022. The World Trade Organization has approved a deal to water down intellectual property restrictions for the manufacturing of COVID-19 vaccines. The head of the WTO has previously said she wanted to end what she called the morally unacceptable inequity of access to COVID-19 vaccines. The deal delivers a blow to vaccine manufacturers such as Pfizer, Moderna, and AstraZeneca. Hong Kong's outgoing leader Carrie Lam is urging residents to avoid banquets and other large gatherings amid a resurgence of COVID-19 in the city, but she held off from imposing new restrictions as serious infections remain low. Lam said today the number of new daily cases has topped 1,000 for the past 3 days, the highest level in 2 months. Fewer than 24 of those people are in serious or critical condition. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The problem with a deep recession right now is you're not getting the fundamental drop-off that the big earnings destruction. Right now, as we sit, if it is going to be a shallow recession because we haven't had the drop-off in fundamentals to the magnitude of a deeper recession.
Keep throwing this R word around, recession. We need to talk about what kind of recession we'll get if indeed we do get one. Andrew Slimman there of Morgan Stanley Investment Management, alongside Lisa Abramowicz and Damien Sassower. I'm Jonathan Ferro. TK, Tom Keene out of the building. Futures up 0.9% on the S&P 500. The Nasdaq 100 up a little more than 1%. Yields climbing higher by a couple of basis points. 321.81 on a US 10-year. The president sitting down with the press. Lisa, the print press for the first time, I think, since February, to do a one-on-one interview with AP.
Yeah, to basically talk about how the U.S. can still avoid recession, how he can get down inflation, how it's not due. And this, I think, was the biggest takeaway. A huge defense about how it wasn't due to stimulus that inflation picked up so much, that was not a main driver, that he has talked to Yellen. It was sort of a nod to that whole interview, and basically rejected that as one of the significant reasons why we have inflation that's so much higher than people expected.
Acknowledge that people are really, really down.
Yeah.
That's something that has changed over the last few months, because this is a story they tried to deflect, tried to ignore going into the back end of last year, and it's the kind of story you can't ignore anymore.
Especially not with approval ratings that are as low as they are, and especially not with gasoline prices at $5 a gallon, and not with the grocery store bills that are driving people to feel pretty negative, at least if you look at the University of Michigan Sentiment Survey.
Emily Wilkins joins us now of Bloomberg Government down in D.C. Emily, what did we learn from the president yesterday?
So, I mean, Biden is really trying to really push the message here that his administration is doing whatever they can to keep the economy good. He knows that inflation is a problem. He knows it's going to be a problem in November when Democrats look to keep the House and to make gains in the Senate. But you really kind of see that the president's really relying heavily on messaging right now. You've seen officials within the White House sort of really going on TV, talking about the things that the administration is doing. A number of them actually came to Congress yesterday, met with House Democrats. Really nothing new in that meeting, but just hammering home the various talking points on inflation, on the economy, on what the Biden administration is choosing to do. And I think this interview yesterday was just even showing more. It's not very common that this president sits down with the print media and gives an interview. So the fact that he chose to do it and chose to do it on this topic shows how desperately the White House is trying to get the messaging aspect under control. But of course, you know, Americans, when you're driving around and you're seeing the gas prices, when you're going to the grocery store, I mean, that tells an entirely different message, and it's something that Democrats are trying to grapple with.
Emily, how much discussion is there about the strong message of changing up the cabinet?
We haven't heard a ton of that yet. There was certainly concern within the White House after Treasury Secretary Janet Yellen did say that she had been wrong about inflation, wrong that it was only going to be transitory. That's certainly something that sent ripples through the administration and Washington, D.C. But at this point, we haven't really heard anything concrete about changing things up. We have seen some turnover at the White House, just various folks within the administration. Part of that could be they've been there for 2 years. It's a pretty grueling job. They're looking for something potentially new. And part of it might be sort of reading the tea leaves. I mean, this is an administration that has very low approval ratings. Recent Morning Consult poll showed that only a quarter of Americans think the country is on the right track. It's not exactly a super positive time to be in government here.
Which raises the questions about 2 years from now in 2024, when President Biden may be running for re-election, how he should get ahead of this and how the Democratic Party should position if his approval rating doesn't recover all that much. What is the discussion when it comes to bringing in another frontrunner for the Democratic Party to potentially run in 2024?
You know, Lisa, that's a really great question. At this point, Biden has said, and said again this week, that he will be running in 2024. But certainly there are a number of contenders within the party who would potentially be looking to make a run. Should that change, or should they feel like they are the ones who really need to step up? And I think there's also a big question, too, who winds up being the Republican nominee? Is it Donald Trump again? Is it someone else? What sort of matchup are you looking at there? In terms of really what Biden is trying to do, they are looking at what minor levers they are able to pull on the economy. You see that Congress right now is working on a bill to bolster U.S. manufacturing, development, research. That's something that as it continues, you're going to be hearing more and more discussion that this is a bill that's going to address supply chains, that's going to try to address inflation. But really, this kind of goes back to the fact that the White House can only do so much from inside D.C., that this is a problem that does have some global implications and still is tied up in the COVID-19 pandemic.
You know, Emily, I believe you're referring to the bill where we're talking about increasing competitiveness with China, right? The $50 billion for semiconductor manufacturing, all that kind of good stuff. I think President Biden and President Xi are expected to have a call in the not too distant future. I think there's a trip planned. I mean, what are your thoughts on that? What's the tone on the relationship between the U.S. and China?
So we're still learning some more details about this potential call. It's in the works right now. It could occur as soon as July, and we're keeping a close eye on this simply because we've seen top U.S. and top Chinese officials meeting together. We saw National Security Jake Sullivan talking with his Chinese counterpart for 4.5 hours in Luxembourg this last week. And so that seems like a potential signal that you're going to come up on another phone call between Biden and Xi. And as far as what's going to be discussed, you're hearing some top administrative officials saying that it's really important to set some guardrails in that relationship between Washington and Beijing, make sure that any disagreements between the countries don't escalate to a larger conflict. Certainly many areas where that could happen, notably in Taiwan. There's been the reporting that Chinese officials are trying to sort of claim the Taiwan Strait while the U.S. is saying it's international waters, and a lot of sort of question marks, I think, in that area of the world about what might come next.
Emily Wilkins down in DC. Emily, thank you. Just to build on Damien's question, Ambassador Nick Burns, old friend of this programme actually, saying if we want stability in the relationship, that takes connecting. Damien, your thoughts on policy? That's what I want to talk about here, not the dictator tour. Going to speak to Crown Prince Mohammed bin Salman, catching up with President Xi. What does it mean for policy?
Well, I'm so happy you just brought up Saudi Arabia. I mean, look, there's winners and losers in every market, and Saudi Arabia is certainly a winner. I mean, they're going to have a budget surplus of 10%, a current account surplus of 16%. And Jonathan, their GDP in nominal terms is going to rise to $1 trillion next year. That's a 50% increase over the last 3 years. And by the way, Biden, you're absolutely right, just announced for finally an ambassador to Saudi Arabia, and he's planning a trip there next week. So we can actually see the carrot stick being lent out.
And the problem's on the screen, Lisa. It's Brent Crude, 121.
Yeah, the winners right now are noteworthy. It's not just Saudi Arabia. It's also Qatar, and how they have a huge natural gas resource. And so Europe is tapping them. I mean, all of the players in the Middle East that are getting emboldened and enriched by this current era.
Big foreign policy implications. Futures right now up 0.9% on the S&P 500. We'll be catching up with Howard Ward, the CIO of Growth Equities for Gabelli Funds. Looking forward to doing that in just a moment. From New York City this morning, good morning to you all. Heard on radio, seen on TV, this is Bloomberg Surveillance. Looking to wrap up a really brutal week on the S&P 500, down about 6 percentage points through the close into Thursday, on the week so far into Friday. Trying to bounce back and snap some of that, trying to bite into that loss this week, up by 0.9% on the S&P. On the Nasdaq 100, up a little more than 1 full percentage point. Still heading for the biggest weekly loss since the pandemic. So far, at least. Let's see what happens this Friday. Let's get to the bond market, 2s, 10s and 30s. Your 2-year yield up just 9 basis points so far on the week, but you put it together with last week, a move of 41, up about 50 basis points over the last 2 weeks. Some big moves here in the bond market. Yields higher again by 6 basis points. So at the front end now, your yield on 2s, 3.15, let's call it 3.16 on 10s. Around about 3.22, came close to 3.50 a little bit earlier in the week and then backed away. Earlier in the week, the spread between Italy and Germany, 240 odd basis points. Now, about 190. Take a look at this. Italy versus Germany. That spread is getting tighter. The difference between the two getting narrower. The story, the ECB. The ECB pushing back and saying they're going to come up with a mechanism, a vehicle to deal with this. And Lisa Visco of the Bank of Italy turning around and saying that maybe 150 is justified. Basically giving a number, telling you the number that is justified. I mean, this is central banking in the modern era, I guess, but it's getting a little bit ridiculous.
Well, he said that it shouldn't exceed 200 basis points, that if actually you look at the spread, it should be under 150 based on economic fundamentals. This has got to really bother people in the ECB. They're trying to actually help out. And he says, basically, you're not doing enough. And by the way, everybody just has it wrong. And please price it better.
So is that a ceiling on the Italian 10-year spread with Germany, or is that a floor? Is that basically telling the market this is justified? 150? Is it a floor or a ceiling? How do you think about it?
Is anyone listening to him? That's my question.
Clearly the market's
he's not the one with
responded, though,
power.
Lisa, to some extent, the market's responded to this, right? Do they need to follow it up and actually do something? The words are working. For now, we've gone from 240 to 190. Something's happening here.
Yeah, but the cohesion in the ECB in terms of how far to go with that bond purchasing program, are they going to go full Japan in terms of controlling that entire market, or are they going to be a little bit more receptive to what the risks actually are being priced?
That's what we're calling centrally planned bond markets now, full Japan. Euro dollar 105.17. That currency pair, Lisa, down about 0.2%.
Yeah. I'm watching the euro. We saw it break down to 103. How much do we start to see parity, the main theme, especially as the ECB has a real rock and a hard place to parse through right now?
Something to look for over the next couple of weeks.
So right now, I want to get a sense of how much we are looking at a buying opportunity. And that's something that a lot of people have been talking about. How much pain have we already baked in? Howard Ward has typically focused on growth equities. He does have the chief investment officer hat for growth equities at Gabelli Funds alongside Howard Gabelli, Mario Gabelli. How much are you looking right now, Howard, for looking at a buying opportunity of some sort of ceiling in yields that we already surpassed with the confirmation from the Fed this week?
Well, Lisa, it certainly has been very painful. The pendulum has swung from full greed to, I think, pretty full fear. And that's the good time generally to be buying stocks when they're down. You got the S&P down over 20%, the NASDAQ down over 30%, a lot of stocks down 40, 50, 60, even 70%. And so I have to believe that unless you think interest rates are going materially higher, this is a good entry point for stocks. And I would note that we think that the reset to multiples from higher interest rates is probably mostly baked in at this point. And I think it's important to realize that after the Fed raised rates this week, which I think reinforced some credibility, which they've been missing in terms of inflation fighting, after they did that, the 10-year bond yield declined. It's about 20 basis points lower than it was earlier this week, as Jonathan just said. So we've had the reset on multiples from the higher rates, the rates more than doubling so far this year. But the next thing has been the reset on the concern about a cut to earnings. And certainly some companies' earnings estimates are too high. Some companies will have lower earnings. But I think in the aggregate, earnings will continue to grow, maybe not at a 10% rate this year, but I think they'll grow. And I think most of my growth stocks will have higher earnings. So in that context, yes, I think this is an excellent time for investors to take advantage of the carnage. It's widespread, it's deep, and I don't think we're going to have, if we have a recession, I don't think it's going to be a deep and long one. I think it's going to be relatively short because the job market is just too strong.
So that's exactly where I wanted to go. How much of this bet is predicated on a short recession rather than a long one? And what's the distinguishing feature between the trajectory of one that is shallow versus one that is much deeper?
Well, this entire problem with inflation and what may or may not be a looming recession is a self-inflicted wound. This was obviously, I think, a result of massive stimulus. The Fed absolutely did blow it. $5 trillion of quantitative easing, 2 years of zero interest rate policy. They expanded the money supply by over 40% over 2 years. And then, of course, we had $5 trillion of fiscal giveaways. How can you not have inflation when you're making those kinds of decisions and those kinds of policy moves? Well, now we've got it. But now we're shocking the system because we're removing all that punch bowl. The monetary stimulus, the growth in the money supply in the last 6 months is down to about a 6% annual rate after an annual rate of over 20% for a couple of years. The federal budget they've spent less money in the first 6 months of this fiscal year than they did the year before. So we're on the right track, and the Fed is finally now raising rates. And mind you, the longer end of the bond yields started rising in August of 2020. So bond yields outside of the short end have been going up for nearly 2 years, and that's starting to impact the economy now. But I think that we're looking at a short recession because you're looking at a job environment where there's 11 million jobs that are open, and you have 5 million unemployed people. And even if you take the 2 to 3 million people that left the labor force during COVID, if they came back, you'd still have a gap of about 3 million. So I think there's a so-called, let's call it a margin of safety on the job side. You'd have to have a really negative environment for the job situation to deteriorate enough for the economy to really tank. And I'd like to point out that part of the problem, of course, has been the supply chain shortages. They're still being resolved, and they are getting better, and every month they will be better, and that is going to help. And I'm certainly hoping, and I'm hopeful that over the course of the next year, we can certainly end this horrible war in Ukraine. That will help. The Fed's doing its part. So I think that we're looking at a situation where the stock market may very well bottom before the economy bottoms. I mean, that would be somewhat typical. And so the data may continue to be negative, but the stock market's going to sniff out an improving economy in the months or quarters ahead, and it will start to move stocks higher. And not all stocks bottom at the same time. Back in 08, 09, many of our stocks bottomed in October and November of 08. The S&P bottomed in late February of 09. And I think many of these stocks that are down 50, 60, 70% they've probably put in their bottoms at this point. It's hard for me to see some of these names going much lower. You know, you can buy Amazon at 13 times EBITDA. I think that is a screaming back up the truck and buy all you can kind of multiple. And I could go on and on. There's been so much carnage in so many sectors of the market. I think you can probably be a happy camper buying a whole range of companies.
Howard, are you backing up the truck then? Can I just jump in? Have you been doing that? Have you loaded up on Amazon over the last couple of weeks?
We've been loading up on Amazon for the last couple of months. And of course, it's continued to go down. But at some point, this is a company that, as you know, is the leader in web services, growing that business at about a 40% clip still. It is the leader in e-commerce. It is a growing leader in digital advertising. This is a company that is going to be a fountain of free cash flow over the next 10 years. Yes, they overexpanded during COVID. And with hindsight, that was a mistake. But they are rectifying that, and they will grow into their capacity. And this is a great opportunity to buy one of America's great companies during a fire sale.
Howard, awesome to get your views. And what a call at the end there. Howard Ward at Gabelli Funds. Amazon down this year, so far at least, Damien, by about 38%.
You know, I picked up a little Amazon about a month and a half ago. It's like the first stock I bought in 10 years, Jonathan. I'm not kidding you.
You're probably not alone.
Yeah. No, I mean, you buy the big four, right? Microsoft, Google, Amazon, and Apple, and you hold your breath and don't look away.
Hold your breath, hold your nose, cover your eyes, Lisa, at the moment, looking at some of these moves.
Right now, the move I'm looking at is the move in real yields and how much that's affected the risk-reward analysis from there is no alternative to there is an alternative if you're suddenly getting upwards of 0.5 percentage point in order just to own benchmark rates. How much does that really shift the multiples in a way that really does reduce the proposition versus that long-term argument that, look, this is a behemoth. It's kind of almost a monopoly at an entire industry and it's going to keep growing.
It's a pretty strong line, though, isn't it? Backing up the truck. Yeah. We'll see how that works out. Some of these names have been absolutely hammered. And what we heard there from Howard, I think acknowledging, Lisa, something you've talked about for a long, long time. Getting the story wrong coming out of the pandemic, how much capacity you needed, how much staffing you needed, how much inventory you needed. And retail's had to adjust to that. Not just that, but also the forward look, the prospect of this weaker consumer too.
Especially because it's moving so quickly. It's not just a wholesale weaker consumer. It's they're shifting what they're buying. They're buying more of the basic necessities. They're buying fewer of the discretionary items. They are buying fewer bulk items. How do you adjust in real time to sentiment and preferences that are shifting that quickly?
Yeah, bit of news up from Reuters I want to jump in on, Damien. PBOC accepting Ant's application for financial holding. That coming from Reuters. I believe we've got a move in Alibaba as well we can take a look at as well. The stock is up by 9.4%. Any thoughts on that, Damien?
Well, I think Chinese equities are basically turning the page here. I mean, look, if you look at Chinese equities relative to the S&P, I think the margin differential has basically just kind of gone the other way finally. I mean, Chinese equities have been in the doghouse since forever. So it's interesting to see Baba, JD, Baidu, all of them kind of rallying off the news.
We'll keep building on that story. The stock up by more than 9.5%. Coming up next, Stephen Short, president of the Short Group. That's just around the corner. Futures higher by 1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. Ukraine is blaming Russia for stoking global inflation. Speaking in a video address to a forum in North Macedonia today, Ukrainian President Volodymyr Zelensky said Russia is using its invasion of Ukraine to spur inflation and risk another migration crisis by limiting gas supplies, blocking food supplies, and targeting farming infrastructure. Zelensky said there is not a single country in Europe that hasn't suffered in some way because of this war. And the war in Ukraine is knocking out shipments of sunflower oil, leading food producers to choose other options like palm oil. Food companies have spent years sourcing alternatives for palm oil, whose farming has led to the destruction of rainforests in Southeast Asia. Palm oil exporters like Malaysia are seizing the opportunity to win back some of that market share. And Bank of Japan Governor Haruhiko Kuroda is holding firm with rock-bottom interest rates, defying an intensifying global wave of central bank tightening. The central bank kept its policy settings for yield curve control and asset purchases today. In a rare move, the bank added a reference to foreign exchange rates to its list of risks for the first time since 2012, following the yen's weakening to a 24-year low earlier this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think the Fed needs an exit ramp from this, because if they're just going to hitch their wagon to energy prices, funds are going to be meaningfully higher, and we're going to push ourselves into, I think, probably a sharper slowing than we probably need to have.
That's the fear, and I think Mike McKee got to the heart of it in the news conference earlier this week with Chairman Powell. That was Tom Porcelli, the chief US economist at RBC Capital Markets. From New York City this Friday morning. Good morning. Futures positive 0.8%, off-session highs on the S&P. On the Nasdaq 100, up a little more than 1%. Yield higher by a couple of basis points, 321.81 on a 10-year. Energy at the heart of a lot of this, Lisa, right now, not just for the chairman of the Fed, but also for this administration, front and center.
Yeah, gas prices leading to some of the low approval ratings for President Biden. What are they going to do about it? We heard about Exxon making more money than God. We heard about possibly taxing profits. At what point does this start to work, especially given the pushback from a lot of the companies where they say, we've been investing, we've been doing everything that we can. It's up to you to come up with cohesive plans.
Stephen Short joins us now, principal and co-founder of the Short Group. Stephen, let's start here. If I could be a fly on the wall of a meeting between the Energy Secretary and oil executives, that's set to happen in a meeting. Stephen, what do you expect will happen in that room?
Yeah, I would expect a lot of pushback right now. It does appear that both the industry and the White House are talking past one another. The White House has refused. This is the first real outreach that they've made to the industry, and and they've gone to some nefarious characters prior to this. And yet they're going to continue to double down and tell us we don't need to drill. You don't need to drill. You just have to raise capacity. Tell you what, capacity is already there. At this time of the year, refinery capacity is at 94%. That is extremely high for this early in the season. So the industry, it has responded. Gasoline production is over 10 million barrels a day for 2 consecutive weeks. Crude oil production has risen. Unfortunately, at the heart of this is the lack of refinery capacity, and there's nothing anyone can do about that. Here in Philadelphia, we had the South Girard refinery that was producing 330,000 barrels of crude oil a day. 40% of that was gasoline. We no longer have that. You go to South Philly, that refinery is no longer there. It's a brownfield, so you're not bringing that back. So we've slashed capacity over the last 5 years. We don't have the same ability. So now we're more reliant on foreign production coming from Europe and from Houston. And there, guys, is the real problem. And that's the one thing the administration, and I do know this is part of what the executives are telling the Secretary of Energy, revoke the Jones Act. Now, for those not familiar, The Jones Act is a maritime law passed about 1,000 years ago, meant to protect the merchant marine industry, domestic merchant marine industry. The problem now here is, since we don't have enough pipeline capacity, we don't have enough refinery capacity here on the East Coast, we need to ship that gasoline diesel fuel out of Houston and into New York Harbor. But the Jones Act says that commerce interstate has to be transacted on an American flagged vessel. We simply don't have enough American flagged vessels.
Stephen, barring some sort of change to the Jones Act and frankly, some sort of wholesale shift that we're not going to see in time, the tightness of the market has raised concerns of the likes of Goldman Sachs' Jeff Curry. How much are we looking at gas prices that will continue to climb? They have been plateauing recently, but will continue to climb throughout the summer to levels that we can't really imagine right now.
Yeah, absolutely. $120 barrel oil, crude oil, both in Brent and WTI, which is pretty much where the market has been holding, to your point, has steadied out around there. But as demand continues to pick up as we approach the 4th of July holiday, the AAA national average is slightly right around $5 a gallon at the pump. Right now, 4th of July, we are forecasting $5.40 on a national average. So there's still more pain at the pump to come. And this is contingent upon oil holding at $120 a barrel. Every dollar oil goes higher, you're going to look at another 2.5 cent rise at the pump.
Stephen, forward curves are pricing in a sharper price decline in nat gas than oil. You know, for me, I'm wondering, do you think that the price rise in oil is stickier than that of nat gas? And if so, what are the implications for example, integrated oil companies out of LATAM or the Canadian oil sands companies, all of which are more focused on oil?
Yeah, absolutely. Natural gas, it is a more seasonal market. You have two distinct markets. You have the winter and the summer. In the shoulder months, you have the refill seasons. So at this point, that backwardation is telling us that there is not enough supply. Right now, the month of May and June is when we store the most natural gas getting ready for next winter. Now, this year, it has been hampered, of course, by LNG exports or European demand for exports because they, too, have to build natural gas. So that steep backwardation priced in is telling us the market is clamoring to get gas into the ground for next winter. Now, last week, we had an explosion and a fire at an LNG export facility down in Texas. Now, that export facility accounted for about 1/5 of U.S. LNG exports. So that LNG plant is going to be closed now to probably at least October, if not November. So that's a lot more gas that's not leaving the United States that's going to be set for domestic consumption and storage. So with that added gas coming to the market at this point, you're looking at a correction in the yield curve and the backwardation, that is the front month prices, have been extremely high relative to the back end, but that's starting to correct lower because we have all this found natural gas. Now, as far as the integrated oil companies go, look, natural gas is a fossil fuel as well. So it's in the same sights as oil with regard to policy and the lack of policy with regard to promoting both natural gas production and crude oil production. And therefore, it does set the table for continued higher prices and a squeeze on margins for the companies.
Stephen, I've got 30 seconds left. I want you to throw a number on it. We're at $5 gas right now. Gasoline prices on average in America right now. By the end of the summer, do you share the JP Morgan view that this is going to have a 6 handle?
Yeah, we're about at a 14. Our modeling is at a 14% probability. We see that. The problem now is it's a race. Do we see that $6, which I said is a 14% probability, or do we see such a severe economic downturn where we see demand destruction and prices fall? Because that's where we're headed. We're headed for recession if we're not already in it at these high food and energy prices. So, yeah, I'll give it 14%. I'm on board 14% of the time with JP Morgan and that prediction.
Just 14, Stephen.
So specific.
Stephen Short at the Short Group. I like JP Morgan, just on board with them 14% of the time. Does that work for you, Bramo?
Yeah, solid.
Very carefully calibrated over there at Short.
Especially 14% chance. I've got a 15% chance that I'll agree with that in any given moment.
I noticed this move in the equity market yesterday, and I think it got a lot of people's attention. Damien, energy was down and down hard by 5.6%. Energy
that's
stocks.
a big indicator. I mean, look, it's one of the big four, right? You look at put-call ratios, you look at breadth of the market. Energy was up, 50% year to date, the energy sector within the S&P? And some. And it was the only sector that was positive, by the way. So we needed to see a little bit of bloodletting there.
Backing away, it's an anticipatory asset class here, Lisa. We're starting to see those gains just get chipped away at.
The only tool that the Fed has is to reduce demand at this point when it comes to things like oil and gas, and people are taking that seriously.
The S&P up 30, advancing 0.8%. Victoria Fernandez across Mark joins us next on this program from New York. This is Bloomberg.
I think the Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
It feels like global inflationary pressures have the upper hand.
Fed rate hikes just take a really long time to impact the economy.
I just wonder whether we're going to look back and say, we were in a recession. We're already in a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
A chorus of negativity there from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. TK out of the building in the seat. Damien Sassower. Equity futures up by 8 or 9%. Lisa, you heard it there as we open this hour. This pushback against these forecasts. Bank of America saying this. The Fed funds forecast now makes sense. Their growth and inflation forecasts do not.
For them to achieve lower inflation, given what they're hoping to do on the rate side, they have to induce a slowdown in demand that will be incredibly painful. That has been the projection from so many investors because the inputs on the supply side have not contributed to a softening in inflation. And without that, it could be a painful period. You asked the question, how long and how deep?
Chairman Powell speaks a little bit later. Are we expecting anything from that whatsoever?
If he takes questions, I'm sure a lot of people will be asking him, how do you view some of these projections about the amount of pain that the U.S. economy is going to have to experience in order to dampen inflation? But no, he said what he was going to say, and now we have to wait and we have to see.
Hey, Damien, it's tough, isn't it? If you're a central banker, if you're the leader of the Fed, you can't forecast a recession even if you think there is going to be one, right?
I think Scott Menard had a really good choice of words using Fantasyland, spoken like a true Los Angeles inhabitant. But for me, markets are operating as if the Fed put is dead. The Fed put's not dead. It's just in hiding in hibernation, in my opinion. So the question I have is, at what level is it a spread level? Is it an equity level? At what level is the Fed going to come back in and back up asset prices?
Let's go there. I say it's in retirement. What brings it out of retirement? Is it the market, as you pointed out, or is it in the economy? Is it in the economic data and not necessarily the inflation data? I'm thinking more at the moment, Damon, about the labour market data.
See, I'm thinking it's going to be spreads. I think it's going to be liquidity driven. I think it's going to be the secondary market drying up. I think there's going to be some problems in the plumbing, and I think the Fed's going to have to act.
We saw that at the back end of 2018, Bramo, didn't we? The primary market for high yield seized up, no issuance through that whole month of December. We're going to see something similar this time around. What do you see right now?
Some people have speculated about this. Others are saying the institutions are starting to buy in bulk. They are providing that liquidity because suddenly 8.5% yields on junk bonds look pretty good. At investment grade, 5% yields also look pretty good. I keep going back to what Eric Robertson said earlier in the morning, where he said, honestly, the only thing that it's going to be is the labor market data. A lot of people seem to agree with that.
I've had one complaint this morning from the audience. Just the one complaint so far, and I'm sure there's more still to come, but just the one. Not enough golf talk in a previous hour, Damien. Not enough golf talk.
Rory McIlroy.
You think Rory gets it done?
One stroke off the lead. I love him. I'm definitely rooting for him this week. But, there's some other players there. Dustin Johnson, Justin Rose. I think
Justin
they're 2
Rose.
shots up. Yeah.
Was that Tom complaining?
It was Tom and someone else as well. They just want the golf talk in the mix. And maybe I do too. Phil Mickelson, can I just say this?
Yes.
He got a decent reception, Damien. I thought that perhaps he'd get some jeering, some boos, but he didn't.
Well, his putting sure could have used a little bit more cheering. I think he missed 14 putts through the first 6 holes or something crazy like that. And he ended, I think, 8 over par. So
I don't think he's making a weekend.
I don't think he's going to make the cut.
I don't think he's making the cut. He's making his money elsewhere at the moment, as we know, Damien. Damien Sassower in the seat. Tom Keene away. Your equity market's higher, up by 8 or 9% on the S&P. On the Nasdaq 100, up a little more than 1%. Yields higher by a couple of basis points, 321.81. If I had to pick an asset class right now, I know there's tons going on in credit, but But foreign exchange, Lisa, foreign exchange is fascinating. Euro dollar negative a third of 1%, 105.15.
Dollar strength very much coming through after the Fed signaled they were going to do what it takes. Although the stickiness of 105 I find interesting, a sort of resilience after the ECB came out and seemed to support peripheral bond yields yesterday. How much does that really feed into some conviction around the euro? Here's what I'm watching today. 8:30 a.m. President Biden is hosting the Major Economies Forum on Energy and Climate. This is a tough message for him to dovetail. He ran on greenifying or the greenification of the energy system. And here we are with gas prices exceeding $5 a gallon. And this is becoming a major problem for him, given how much it eats into the disposable income, particularly of people on the lower income brackets in the United States. 8:45 a.m. we hear from Fed Chair Jay Powell. John, you asked me, are we going to hear anything of substance in terms of what would cause them to retrace or possibly pause some of their rate hiking? He's going to be talking about the dollar and the strength of it, how much they start to look at their international role and the disruptions that they could see outside of the U.S. as that dollar does continue to strengthen. That's actually one thing that he could talk about. And at 9:15 a.m. we get U.S. May industrial production. How much do we start to see production increase to offset the increase in demand? A possible easing of inflation that comes not from simply dampening demand and slowing the economy. John, this is what people secretly hope, right? They say, yeah, we see inflation surprise to the upside, but there's a subtle transitory kind of feel that still is alive in some of the discussions that you hear.
Some economic data a little bit later. Lisa, thank you. Following up on that data, responding to it, reacting, we'll catch up with Mohammed Al-Arian around about 9 o'clock Eastern time as we count you down to the market open. The scores right now look like this year to date. Tom, this is for you. The Dow down 17%. Won't be doing that again. The S&P 500 year to date down about 23%. The Nasdaq down by 32% year to date. Joining us now is Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, we're down 32% on the Nasdaq year to date. Are you buying any tech stocks yet?
Yeah, actually, Jonathan, I mean, you're right. Look at how far the Nasdaq's down and look at individual stocks within the Nasdaq. And some of these tech stocks have come down even more. NVIDIA is a name we actually bought this week. NVIDIA's down 48% year to date. But we're looking at a company that had good earnings, a company that's growing with their data center, with their gaming. So there's a lot of good companies with strong balance sheets that are out there that have taken a significant hit as yields have moved higher. And so I think you can go in, be a little opportunistic, and add some names in there. And it's not just in the tech space. You can do it across the board, but you've got to choose quality companies. Don't just go all in on one sector like we used to do a couple of years ago.
Victoria, you don't believe the recession talk. You think that the U.S. can avoid one. Why?
Yeah, I mean, look, probability of a recession probably went up over the last 48 hours or so, but I don't think we're going to have a recession this year. I still think the underlying fundamentals in the economy, when we look at household balance sheets, I know we have gas prices going higher, and that's taken a big hit, and food prices higher. But when you look and kind of split up household balance sheets, higher wage earners are doing pretty well. They respond more to household wealth than they do commodity prices or food prices. They're still strong. Corporate balance sheets are still good. We haven't seen those earnings expectations come in yet. That's something we were looking for to maybe think that recession is closer than next year. So we're sticking with next year on that. And the labor market, you've talked about it all morning, it's still strong, even though the Fed is trying to bring that down a little bit to help inflation. So we don't see a recession this year. We would see it more likely second half of next year. But again, things can change pretty quickly if the Fed continues to increase at the rate that we've seen.
Victoria, if the Fed does indeed engineer a soft landing, by the way, inflation's unlikely to return to pre-COVID levels anytime soon. I mean, what asset classes in that environment, specifically on the fixed income side, would you prefer owning?
Yeah, so Damien, in our fixed income portfolios, we've actually been short duration for an extended period of time, which has worked really well for us lately. What we've started doing is really extending duration, building up some of that credit. I mean, you talked about yields earlier, you talked about spreads with high yield and with an investment grade. We prefer, just like we like quality in equity, we want quality in fixed income. So we're looking at high quality investment grade corporates. We're getting more yield on them now. We're adding some of those to our portfolios, but we're doing it while trying to extend duration a little bit to get closer to neutral, because we do think We perhaps have seen the peak in yields at that 350 on the 10-year Treasury earlier this week, and we'll start to see yields settle at a lower level. So if we can build in some of that yield now and lock it in the portfolios in quality corporate names, I think you're well positioned.
Victoria, let's just finish on that. How do you expect that relationship, that correlation between risk assets and treasuries to develop through the summer?
Look, I mean, one of the things we're watching, actually two of the things, Jonathan, energy and 10-year yields, they usually peak prior to data peaking, whether it's inflation or other data. Have we seen that? That's the question. We don't know yet. So there's the correlation. If we can see the peak in yields and start to see yields moderate a little bit, that should be some support for the equity markets over the summer months.
Victoria, awesome to hear from you. As always, Victoria Fernandez there of Crossmark Global Investments. Who said it first on this programme a number of weeks ago? Was it David Stubbs of JP Morgan Private Bank? Lisa, who said bonds are back. Bonds are back. Then Scott Minard, earlier in the week on the Fed show with us and Tom as well, saying that he was thinking about the long end of the bond market as well. 350 got close. Yields have backed away since then.
Yeah, Subhadra Rajappa seemed to emphasize that as well. We saw that yesterday. I'm looking right now at the Bank of America Merrill Lynch Move Index, and that still is incredibly elevated. We're looking at levels. This is basically implied volatility in Treasury yields going back to 2020. We haven't seen these levels of implied volatility. So I think it may be a little soon to say that we've seen that peak, especially as people project out 4% Fed funds rates.
To build on that just a little bit, Damien, I think I've heard someone call the top on yields about 20 different times over the last 12 months, and then we break out again, which is Lisa's point.
I mean, Jonathan, markets are pricing in a 9% CPI print in each of the next 2 months. So, that tells you everything you need to know about the pressure. It's to the upside, I think, on U.S. yields. And certainly if we break through 356, that's when things get a little bit messy.
What would you be looking for after that?
375. If it breaks through there, it's
pushing
4%. Yeah.
Can you imagine 4%? Lisa, do you think we've fully adjusted to what's happened in rates?
Okay.
I hear this a lot in the equity market. We've adjusted to the rate story.
Right.
Fully adjusted. Now it's about earnings. Do you think we have?
I think if we get a 4% 10-year yield, everything changes. I think that will be a game changer in many ways. What I'm struggling with right now, rents. Well, how are they going to come down? We're not even seeing housing prices come down that fast. And if people are priced out of buying homes, they're going to have to stay in their homes and rent more. That's going to create more demand. I'm trying to pair this all together. It's not adding up.
Jonathan Golub of Credit Suisse is going to join us and try and make sense of it all. He's got a more constructive outlook on this equity market, and particularly on earnings too. Your equity market up 0.9% on the S&P 500. We'll catch up with Golub in the next hour on Bloomberg TV and on Bloomberg Radio. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will convene world leaders from roughly 24 countries in a summit today focused on propelling the fight against climate change. The virtual summit is on track to be the largest gathering of world leaders focused on climate action ahead of a critical United Nations summit in Egypt this November. Biden will highlight the war in Ukraine as evidence of the need to accelerate the clean energy transition and bolster food security. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. Russia's invasion of Ukraine caused one of the fastest and largest displacements of people since World War II and helped push the number forced to flee their homes globally to the highest annual level since the United Nations began keeping track. The UN Refugee Agency said today the number of people displaced around the world tops 100 million, and the war in Ukraine has displaced about 8 million people within the country so far in 2022. Hong Kong's outgoing leader Carrie Lam is urging residents to avoid banquets and other large gatherings amid a resurgence of COVID-19 in the city, but she held off from imposing new restrictions as serious infections remain low. Lam said today the number of new daily cases has topped 1,000 for the past 3 days, the highest level in 2 months. Fewer than 24 of those people are in serious or critical condition. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The Fed is shown that it's going to have to be very data dependent over data that it doesn't necessarily have a great deal of control over. The Fed is somewhat captive to the incoming inflation data that matters a lot. And then the growth outlook is also very uncertain.
That was Andrew Sheets, the chief cross-asset strategist at Morgan Stanley. His view, and many others too, from New York City this morning. Good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro, together today with Damien Sassow. TK out of the building. Here's the price action. Equities up 32, advancing 0.9%. Yields higher by a couple of basis points, 121.62, or rather 321.62. I've got my cap on from 10 years ago. It has a 3 handle now. In the FX market, euro-dollar 105.16, euro-dollar negative about 1/3%. This story just crossing from the Washington Post, Lisa. Here's the second paragraph, first couple of lines of it. Biden officials are taking a second look at whether the federal government could send rebate cards out to millions of American drivers to help them pay at gas stations.
Yeah, but the second line or the third line is also fascinating, that in the past they've rejected this idea because of a shortage in chips that were needed to make that card, just highlighting how multifaceted some of the shortages and supply shortfalls have been.
You couldn't make that up, could you?
You could not make up the fact that they couldn't get the rebate cards in enough supply because of the chips. But look, do you really want to basically keep demand at the same level? This is sort of the existential question. Do you want to keep demand at the same level and then basically have this be a supply issue that cannot be fixed because supply can't come on quickly enough? And then you just basically end up in this inflationary spiral, or do you go at this somehow differently?
And you've got to finish with the last line of this paragraph as well. Even if the administration embraces the proposal, Damien, it would probably require congressional approval and face long odds among lawmakers wary of spending more money.
Well, I have to draw a comparison to, to really to the GCC, to the Middle East, because quite honestly, fuel subsidies work there. They've suppressed inflation pretty nicely in places like Saudi Arabia, Qatar, Kuwait. Maybe we're pulling a feather out of that hat. Who knows? Maybe we can kind of bring down that demand that Lisa's referring to, because quite frankly, that's the only way we're going to get this economy right-sized.
I mean, I guess it helps if you're the state producer as well and you make money from exporting it to everyone else and then you dole out some subsidies domestically. That's probably how that trade works. I'm not sure how that works here.
Well, no, you're absolutely right. But I think, look, the fact of the matter is it's not just fuel subsidies, it's food subsidies. I mean, if you see what's going on in places like Pakistan, Sri Lanka, I mean, everywhere. I mean, you're seeing rioting in the streets, you're seeing protests everywhere. It's a very big deal. And it's about social instability, I think. And that's really the key point. Look, guys, many know I'm an emerging markets guy. So those are the things we look at. And I got to tell you, things are getting far worse.
Let's get to Emily Wilkins down in D.C. of Bloomberg Government. Emily, I want to start with the headline of this story from the Washington Post. Soaring gas prices lead the White House aides back to brainstorming. What are they coming up with?
I mean, at this point, you kind of note that there is the idea of potentially gas cards. I mean, they've talked in the past about a gas tax holiday, but that's something that you saw House Speaker Nancy Pelosi shut down pretty quickly, saying, look, we're not sure if we try and give this gas tax holiday, companies might not pass those profits along to consumers. And that was why that idea got nixed. They're looking for other potential avenues to have something like this. But then there's also the question about the international aspect, about what Biden is doing, about which countries he's working with. Certainly some eyebrows being raised about that proposed trip to Saudi Arabia and what that could potentially mean for the U.S. going forward. At the same point, lawmakers are really feeling the pressure to do something here on gas prices. I almost wonder if we will see some sort of legislation that will have some of these subsidies or potential gas cards, even if it's something that is only able to, say, pass the House and not able to go forward in the Senate, just so Democrats can say we are trying to do something, to go back to voters and show them something.
Emily, there is this sort of unspoken truth that at a certain point, people will start rationing how often they travel. They will start reducing certain aspects of their lives in order to offset the higher costs. At what point will the administration lean into that and say, if we all can just basically turn off the lights, as we were talking about earlier, or take a few fewer trips, then that will actually ease the problem itself?
It'll be interesting to see, because initially the Biden administration did kind of begin to talk about it in those terms. They said, look, there's high support in the U.S. for the war going on in Ukraine, high support for Ukraine. And look, if people have to pay a little bit extra at the pump so the U.S. can make sure we're not getting any Russian oil, that might be something that people would be interested in. That, of course, was before you saw gas prices get quite as high as they are now and really trickle into inflation in other items like food, groceries, anything that really does need to be transported. And so I think it is a major concern, and I wouldn't rule out anything at this point, because the Biden administration and Democrats in general know that it is such a problem that they do have to come up with some sort of solution. I think there was initially a hope that, you would see Biden tap into the Federal Reserve, that you would see lawmakers try to take smaller measures to address it, and you might see prices go back down, but that has not happened. And as you mentioned, it's summer, you've got families who are looking to take these trips, and you've got gas prices that are really prohibitive for a number of people to drive as far as they would like to.
Emily, can you clarify for me? I mean, what I see is President Biden reaching out, trying to mend fences with Iran, Venezuela, now Saudi Arabia, and yet on the flip side of that, he's accusing ExxonMobil domestic producers of price gouging. Is this just plain old politics?
There is certainly a little bit of politics that comes into here. This is certainly Washington, D.C. I think Democrats have made a calculation that most Americans are not super big fans of major corporations, and that it's going to be pretty easy to pin the blame on them, particularly with some of the revenues that we've seen from these oil companies. The Exxon numbers this week led to another round of the White House saying, hey, why are the profits so big? Why isn't some of this being passed along to consumers? And I think it's this point the White House is sort of looking sort of everywhere at this point for if there's any avenue that they can take to lower prices, if it's going after big companies, if it's working internationally. They're kind of scrambling here to figure out what the solution is going to be and if they can have prices go down in the next couple months before the November elections.
Emily, thank you. Down in Washington, Emily Wilkins there of Bloomberg Government. I'm going to take the audience back to the end of last year. It was at the end of October where the Energy Secretary came on this program, and we asked what you could do domestically to boost output. And what did we hear? Laughing. Now, Damien, I don't want to understand why it's gone from blaming OPEC to now blaming domestic producers, when 6 months ago we had a similar story, and Russia wasn't a factor, of course, and we can add Russia into that, but we could see the direction of travel. Energy prices were already very, very elevated at the pump, out of the ground, the drilling, all of the above. And yet we got laughed at when it came to suggesting boosting production here at home. And now it's all about domestic production.
Well, for me, I mean, look, and I think Emily kind of, did a good job of avoiding it. I mean, we're talking about Texas here. We're talking about terrorists versus Texas. I mean, and by the way, terrorists, I'm not accusing anyone of being a terrorist. But I mean, look, that's exactly what the market believes. The market believes that Biden is picking his spots here, and he'd rather reach out to, unsavory actors as opposed to domestic producers. And, they're all, look, that's big Texas. That's a Republican stronghold. And so I definitely think it's a political issue.
Dictators or Texas? Maybe a more savoury way of saying
wonderful.
it, but some people might agree with you. Futures up by 1% on the S&P 500. The president seemingly would rather go and see the Crown Prince Mohammed bin Salman at the moment and try and do something there. We'll talk about this some more. From New York, this is Bloomberg. Live from New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance, and here's your bounce back. Futures higher, positive by more than 1% on the S&P, and the Nasdaq 100 up by 1.4 through Thursday. The losses this week down 6%. Close there, biggest weekly close, weekly loss going all the way back to the pandemic. Bramo, it's been that bad. What was interesting about yesterday is that we had energy, crude rallying, but energy equities falling. Is that the first sign that this market's starting to price in some demand destruction on the energy side in this equity market after a monster rally year today?
If you're going to give it a narrative, that seems like a good one to give it. There was a whole host of selling that people didn't quite understand yesterday, though, as well. You do wonder whether people are selling what they can, maybe not what they want to, at a time when it's very unclear what the trajectory of the economy is going to look like.
That's where the profits have been. Let's be clear about that. Where they haven't been is big tech.
Right.
We heard from Howard Ward a little bit earlier this morning of Gabelli Funds, and he was talking about backing up the truck for stocks like Amazon. When we followed up and asked him, he said he was having a nibble, just thinking about it. So we'll think about that too. That's the equity picture. Here's the bond market story. 2s, 10s and 30s. Your 2-year yield on the week, just a little bit higher. Nothing like last week, up by more than 40 basis points on a week last week. This week, up around about 9 so far, including 3 or 4 basis points move higher today by 4 to about 315 on a 2-year. On a 10-year right now, 321.81. Wanted to finish in Europe. Haven't talked much about it this morning, but certainly on people's radars. Are they finally getting something done on the periphery? Because spreads have seen a monster move this week. A couple of days ago, 240. Italy over Germany. Right now, sub 200. Lisa, that's a big move. It's a big move. They're planning to make a plan. They haven't made a plan just yet. And haven't agreed on a plan either. So there's a couple of steps still to go here. Will words be enough to cap what's happened in this bond market? As this ECB looks to do something they haven't done for a long time, since 2011, in fact, and that's hike interest rates.
We have heard that they are going to front load some of their reinvestment of the PEP. So basically, they are going to potentially increase their near-term purchases, and that could potentially offset this. But it's hard for me to imagine for them not to follow up, that it wouldn't have the exact opposite effect on this market.
To see a German 10-year bund through 180 briefly in the last couple of days. I mean, this is a huge turnaround, guys. We're about 167 right now. We were negative 17 basis points at the end of last year on a German 10-year. In Italy, last summer, 50 basis points on an Italian 10-year. Right now, 357. I know we were through 4 earlier this week, but the change we've seen over the last 12 months has been absolutely massive. That's the cross-asset price action. Let's get you some single names, some movers. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Well, some investors are out there trying to nibble. Of course, you talk about futures being higher. A lot of those big tech names also moving higher. That's pretty much your big ballast here, with Apple up about 1%, NVIDIA and a lot of the semiconductor names up about 2%. Similar story for most of those big tech names. The big question is, how much conviction is there right now into some of those nibbles? Is it going to be broad-based, particularly in a market where we've seen a lot of declining liquidity as well as a lot of declining faith here in the economic trajectory? There is some optimism when it comes to a lot of those Chinese tech stocks, Alibaba amongst them. Those shares, ADRs here in the U.S., up by almost 10%. That's on the back of that Reuters report that the Chinese government would actually allow Ant Group to move forward with those earlier plans to convert to a fintech company and, of course, have that IPO. Alibaba, JD.com, and a lot of the other big Chinese tech stocks moving higher here in the pre-market. But at the end of the day, it really comes down to with the commentary that we're getting out of a lot of these executives here. We did hear from the head of JD.com's retail division basically saying that they're seeing basically a lot of muted growth here with people really not opening up their pocketbooks and spending. Then we heard from U.S. Steel last night, which actually raised its profit forecast for the full year. You're seeing those shares higher by about 7%, but there are some skeptical analysts out there, a lot of sell-side notes saying that this is sort of a temporary boom for that company and basically enjoy it while it lasts. Well, it'd be interesting to see whether that price action this morning actually lasts into the end of the day. Adobe also came out with earnings, and this is an interesting story. Those shares are down 3%. The quarter was a blowout quarter by any stretch of the imagination, but they did revise their guidance lower by a relatively minor amount, basically say it's $17.7 billion in sales from a previous forecast of $17.9 billion. But that caused a lot of concern here as a lot of people do start to worry about the backlog with a lot of these companies that particularly were sort of pitched as being a bit recession-proof. The idea that business spending, IT spending would sort of keep a lot of these companies afloat. A lot of concern that that may not necessarily be the case. And keep an eye on Revlon shares here. Revlon up about 67% after that bankruptcy filing on Wednesday. Apparently, a lifeline could be thrown to this company. Reliance Industries over there in India is said, based on a report out of India, that they could be interested in buying Revlon. John?
Hey, Romain, awesome. Yep. As always, sir. Looking forward to the close a little bit later with Romain Bostic and the team. A couple of stats for you. This came from Michael McDonough of Bloomberg. This really jumped out to me, Lisa. He said the following. In January, a monthly mortgage payment based on median existing home price and the going 30-year mortgage rate was $1,200. It's now pushing $2,000. That's the big change we face at the moment.
People's base costs, if they want to buy a home with a mortgage, have basically doubled in that period of time. And what are the consequences long-term in terms of the home ownership versus the rent proposition?
The home builders, Damien, this year, they have been hammered, smashed. The performance of those stocks, brutal.
Well, I mean, look, the indicator I most look at is the Corey Stats, our proprietary index of Westchester home price sentiment. What it's telling me is that you no longer have contingencies. You can't just waive your right to inspection. You can't just waive your right to whether or not a bank is actually going to give you a loan. You're seeing days on market increase. These are all negative factors that are certainly weighing on the housing market.
Damien, is that particular index personal?
Oh, yeah, no,
it's
absolutely.
Personal.
I can give you access, though.
Damien, thank you. Seth Carpenter joins us now, Chief Global Economist at Morgan Stanley. Seth, Bank of America said this: the Fed funds forecast now makes sense. Their growth and inflation forecasts do not. They think the Fed's too optimistic on those fronts. Do you?
There's definitely a lot of optimism in their forecast. What they laid out in their projections was essentially the absolutely perfect soft landing scenario where they get growth to come down just a little bit below potential, and they get the unemployment rate to rise over a few years to just at their estimate of the natural rate. That's very aspirational. That's what they should be trying to hit. And so it makes sense that they would write that down as their forecast. But boy, you got to have some luck to go along with really good policy making to get that outcome.
Based on where inflation is, would the economy have to go into recession to achieve what the Fed is trying to achieve?
I mean, you've got clearly the most difficult question here. And I have to say over the past year and a half, the hardest question is how much of the inflation that we're seeing now is underlying structural macroeconomic inflation and how much of it is an artifact of all the frictions from COVID. And so if we think about the fact, if we look at the Fed's forecast, they're clearly banking on still a bunch of that being temporary and going away on its own. And, you know, the energy prices presumably do that, at least when oil prices stop rising. I think it's really hard to say for sure how much of the rest of it goes away on its own.
The stealth transitory line of thought out there, Seth. One aspect of inflation is the rent picture. It's a big component of CPI. And we're looking right now, as John was talking about earlier, at 6% average mortgage rates, which increase the cost of owning a home at a time when costs already were highly unaffordable. How much does this have the opposite effect of what the Federal Reserve wants to achieve, actually boosting rents further because it prices so many people out of the home ownership market and back into borrowing or renting?
I completely agree. I think in the short run, it could be going in the opposite direction. What we know for a fact is that there's a structural housing shortage. Affordability is at its worst place in decades. And so if people were thinking about giving up their rental to buy a house, they're probably reconsidering that thought right now. So rent matters a lot. I will say, though, central banks, as we've seen over the past couple of weeks, are having some challenging moments with communication. The Fed's going to have an even more challenging moment because you mentioned the 40% weight that rent gets in core CPI. It's a little bit less than half that in core PCE. And of course, it's PCE that the Fed sets a target for. So those two measures of inflation are going to diverge, and they've already diverged to close to historic rates. And that fact is just going to complicate even more so the Fed's challenge in communication.
Seth, the Fed bumped up its PCE target to 5.2%. That's a 90 bip increase since March. You know, I have one simple question for you. Does the Federal Reserve have a credibility problem? And if so, what can it do to regain the confidence of investors?
Credibility is a tricky thing, and the credibility for investors, I think, is critical. We have seen markets continue over the past 6 to 9 months mark up aggressively the path for their expected funds rate. So that to me says the market believes that the Fed will be raising rates and they'll follow through on those rate increases. Moreover, if you look at the Eurodollar futures contract, the market's pricing in some reduction in the funds rate in the out years, which I will point out matches the Fed's dot plot now that there'd be some cutting in rates at some point in the future. So I think in that regard, the market still believes that the Fed is set to raise rates pretty aggressively. And we have seen the curve continue to flatten. So if the Fed had no credibility and inflation were going to be runaway inflation for the next 10 years, presumably you'd see more of that price into the long end. So I don't think there's a complete loss of credibility. I think what's critical now is the Fed being clearer with their communication and following through on their plan.
Seth, always good to hear from you, sir. Thank you for this morning. Seth Carpenter there from Morgan Stanley. I want to go back to the forecast of December 15th. If you have a look at the summary of economic projections on December 15th of this Federal Reserve, this is what they had penciled in for 2022, the median forecast of that committee. For the Fed funds rate, 0.9%. This year end. For core PCE, they were at 2.7% this year end. And you're right, Damien, that has changed in a massive way because for 22, they now see Fed funds at 3.4 and core PCE at 4.3 and headline PCE at 5.2. It's a big change. This Fed has been struggling to forecast, Damien, forever.
I mean,
forever.
Look, the central bank, the Fed is chasing inflation. It's running out of good options, and it's intensifying asset price volatility. Sounds a lot like an emerging market central bank. No, this is the Federal Reserve we're talking about, Jonathan. So yeah, no, I agree with you. Credibility is an issue for sure, and it's going to take some time for them to win it back.
You can't forecast the war, Lisa, and seemingly we can all agree on that. It's had an impact. It's exacerbated things when it comes to inflation, particularly, of course, specifically in energy. But they missed the inflation story through the whole of last year, as many people did, but particularly through the back end of the year too.
Well, and we even got revised employment numbers that really rejiggered how strong that employment market was. There was a belief that there was a softening. It's been a very difficult market to get right. It's easy to cast stones, except for when you're in that house. However, this is a credibility issue for a market that's searching for direction.
These aren't stones, they're rocks. We're throwing rocks at them.
Really?
Smashing windows.
I have empathy. It's a tough picture.
You have empathy with the Fed?
I have empathy for how challenging.
The way you've spoken about the Fed for the last 15 years.
For how challenging.
You've got empathy with the Fed.
For how challenging this picture is to get right.
Okay. And no one believes you. Equity futures at 1% on the S&P.
No one.
You don't believe it. From New York.
Come on.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Sweden's Riksbank has named a new governor. Stefan Ingves will leave the central bank at the end of the year after 17 years of steering monetary policy in the biggest Nordic economy. He will be succeeded by Erik Thedéen, who now heads the Swedish Financial Supervisory Authority. The news comes as the Riksbank has made a momentous policy shift. The central bank is addressing a surge in inflation and is under pressure to speed up rate hikes it flagged back in April. BNP Paribas has expressed interest in a potential acquisition of Dutch consumer lender ABN AMRO Bank. Bloomberg has learned France's biggest bank recently reached out for a meeting with the Dutch government to discuss its interest. Shares of ABN AMRO rose as much as 18% on the news. Cross-border European bank mergers have been rare in the last decade as negative interest rates weighed on results and executives waited for progress on a banking union in the bloc. Airlines have been working hard to convince passengers it's safe to fly, but they're having a tough time convincing staffers to do the same. Aviation officials are facing an unprecedented labor crunch that is resulting in long lines, delays, and the cancellation of hundreds of flights worldwide. The severe staff shortage is sure to be a topic of discussion at the International Air Transport Association's annual meeting that kicks off in Doha on Sunday. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
I personally am concerned that global inflation will creep into Japan. The BOJ will be forced to move, but I'm pretty confident they'll move on their own timeline and that they won't be bullied into this move, and they have plenty of firepower to prevent it.
He is such a sharp dude. It's Greg Jensen there, Bridgewater Co-CIO from New York City this morning. Good morning. Tom Keene away, Damien Sasser in the seat alongside Lisa Abramowicz. I'm Jonathan Ferro. Futures up by about 0.9% on the S&P, up a couple of basis points on a 10-year, 321.81. The Japanese yen. Lisa, what a mess this is becoming for the BOJ.
Yeah, although they don't seem to recognize that. The only recognition was a new line in their statement that came out, the decision, that they were aware of yen depreciation as a potential headwind, as a potential risk factor. But it seemed like they were absolutely going to commit to this rate peg that most people say is unsustainable.
I'm calling this Operation Ostrich, Damien. Just the head in the sand, hoping that everything going on around them is not happening, but it is.
Well, I think the Bank of Japan, Jonathan, I mean, they were very plain and simple. I mean, they are targeting the cheapest to deliver contract on the JGBs. And by doing that, they're basically acknowledging the fact that FX is an issue. I think the last time the BOJ intervened was 1998 when it hit 150. We're not that far off.
Dollar yen right now, close to 135. Let's get your chart of the day. We could do that, of course, with Critty. Morning, Critty.
Well, good morning, John. Of course, you led me right to where I was going to go in my chart of the day. We're using a two-line chart this time, to the horror of Tom Keene. But stick with me here. We're looking at JGB yields, of course, bouncing up against that key 25 basis point level. But it's also looking at that in the context of yen swaps. So once again, the divergence is what's key here. For our radio audience, what you need to know is that these are two lines that move together. They move in sync. But in the last couple of, I want to to say months, since going back to March, you've started to see that diversion to the point that yen swaps are getting higher and higher. Essentially, the weakness getting, or the chances, I should say, of the weakness getting stronger and stronger. One of the big concerns here, to what John was saying earlier, was do we test 135, but not just 135, the record high, the 23-year high of 135.59. That's what seems to be in play here if you don't really see the BOJ remove their stance. And overnight, a lot of the expectation here, if you look at overnight volatility, was that they would do just that. They would somehow tweak their stance. John, in light of them not doing that, of course, you're seeing weakness yet again in the yen.
A ton of weakness. Pretty good to thank you with your chart of the day. Let's carry on that story with Win Thin, Global Head of Currency Strategy at Brown Brothers Harriman. Win, how sustainable is the BOJ's policy stance?
Well, look, I think I agree with Mr. Jensen, your previous guest. They can keep this going. There's obviously stresses that are popping up in the JGB market, but they have unlimited firepower. Obviously, you made a comment about ostrich in the sand. Yes, they are the incredible outlier. You know, the Swiss National Bank hiking rates. So when you're more dovish than the Swiss National Bank, that's saying something. Basically, we tie it back with currency. They can express all they want, all the concern they want about the currency, but I keep going back to Professor Robert Mundell's impossible trinity. You can't have free capital flows, independent policy, and try and target the exchange rate. With zero rates, free capital flows, that exchange rate is just going to keep going to the moon. I think the 147 and change high from mid-1998, I think, is the next big target.
So what's going to stop them? And what's going to be the trigger if it's unsustainable?
Well, again, the yield curve control, to have a target 10-year yield in this era of high and rising inflation, in a sense, it just sticks out. I think it is sustainable, but at some point they have to acknowledge sort of the laws of economics. It's just unnatural to keep these rates targeted at zero when inflation is running so high. But again, I agree with your many of your previous guesses that the BOJ will change, but they'll do it on their own terms. I don't think the market can force them into this. They really do have unlimited firepower. If there's dislocations in the JGB market and some speculators and arbitrageurs get hurt, well, so be it. I think it's a pretty strong statement that they maintain their current stance. Yes, as Lisa, as you mentioned, they play some lip service to the currency. But again, there's really nothing they can do about it as long as they maintain this ultra dovish policy. And monetary policy aversion is really the main driver for FX markets right now.
Wayne, enough with the doves. Let's talk about the hawks. Let's talk about Brazil, Chile, the Czech Republic. I mean, is there room for some of these central banks who were early on in the hiking cycle to start giving some relief, to start injecting some stimulus back into their economies and cutting rates?
Well, I think that was the theme maybe several months ago. But as you know, the inflation story isn't going away. I think there's some hope that some of the inflation measures were sort of topping out. But this obviously this ground war in Ukraine has gone on much longer than I think many anticipated. And so food and energy prices remain elevated. So it's going to be tough. And you saw a shift in Brazil earlier, right? They rather than, I think, previous meetings, they've been sort of saying, well, hinting that, well, we're near the end. But they're pretty explicit that this tightening cycle is likely to go on further. So the swaps market has reacted. It's tough. I think I tie this in with the whole global liquidity story. This is, emerging markets sort of caught in a hard place. They'd love to ease, but global monetary conditions are tightening. It's hard for them to sort of lean against what is really a global trend. So it's going to be a really, really rocky road for emerging markets over the next, I'd say, 6 to 9 months until we sort of see the end of the cycle for the Fed.
Well, Wynn, I mean, that transitions beautifully into King Dollar, right? I mean, let's be very, very clear. Non-dollar bonds comprise over half of the $59 trillion Bloomberg Global Aggregate Bond Index. Talk to me about King Dollar. I mean, what's it going to take to knock King Dollar off its pedestal?
Well, to me, I mentioned monetary policy divergence. To me, I think if a U.S. recession happens, then that's when the dollar rally ends. We've seen the cycle play out during the great financial crisis, during the pandemic. The Fed is the first and most aggressive to go to zero and to crank up the QE machine. So, if and when, obviously a recession will happen at some point. I don't see one at least for the next 12 months if you look at all the tea leaves. But if and when that happens, the Fed is typically very, very aggressive. And that starts the sort of cycle of this, well, the QE feeds into dollar weakness, low interest rates, et cetera. And then we start this whole sort of cycle all over again. So anyway, I think for the next, I'd say at least 6, 9, 12 months, the Fed is continuing to tighten. The end of the tightening cycle is nowhere in sight. The economy is slowing, but remains, in a sense, robust. compared to, I think, what you see in the UK, Japan. I mean, it's all about the relative story, right, in FX. And I think despite all these worries about the U.S. economy, it still, to me, stands out as the most resilient and most prepared to deal with any issues.
Win Thin, awesome to hear from you. Win Thin there of Brown Brothers Harriman. He mentioned at the end there the UK. Just from your perspective, Damien, do you sense that currency is becoming more and more EM-like as the weeks go by?
Well, here's the way I have to look at it. And, you know, you're kind of opening me up to this. I'm just going to give you a stat here. There are only 4 of 21 emerging market currencies that are up versus the dollar year to date. If you look at it in euro terms, 16 of the 21 are up year to date. If you look at it in yen terms, 19 of 21 are up year to date. So look, I mean, this whole, emerging, not diverging, markets, going into this year in terms of looking at EM currencies and saying they're going to be winners and losers. That's true, but it's not true in dollar terms, unfortunately.
We'll turn back to the equity market in just a moment. At the top of the next hour, we'll catch up with Jonathan Golub of Credit Suisse. Let me leave you with this. The median year-end forecast on the south side is 46.50 on the S&P 500. Yes, it is still 46.50. That is 1,000 points, Lisa, above where we closed yesterday.
What did Binky Chadha said? That their base case was 47.50, but their bear case was, what, 3,000?
Something like that. I think Jonathan Golub is going to have some things to say on Credit Suisse. Jonathan Golub joins us next.
We're in for a tough couple of months in markets.
We're certainly in for at least the last several years in broader asset classes.
Higher rates or lower rates are going to be very challenging for equity markets.
These central banks just have to try to assert control and just calm markets.
I think there's an opportunity coming. I just think it's too early.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Damien Sassower is in the seat. TK is away today. Equity futures are higher by 0.9%. The damage done year to date so far, Lisa. The S&P down 23%. The Nasdaq year to date down 32%.
Is it enough? And that's what a lot of people are talking about. If we do go into a recession, what some of the drawdowns would look like and how much more pain there is. The range of potential outcomes have gotten as wide as I have ever seen them. I just keep going back to that range that Binky Chadha put out there of either 3,000 on the bear side or 47.50 on the base case.
Is there a base case anymore? I think people just have a bull case and a bear case. Let's do the bull case, the bear case. The bull case is the damage is done. We've already seen so much selling. It's a buy. The bear case is we've adjusted to rates. We have not adjusted to lower earnings. Which point is the more compelling one, Lisa, right now?
And how much does the stock market have to overshoot on the downside when you do get those earnings downgrades before people start to expect what Andrew Sliman was talking about, which is the next phase, the next cycle? And typically markets do get ahead of that. It's unknown. We don't even know what we're dealing with in terms of multiples. We don't know what we're dealing with in terms of inflation. And we don't know what we're dealing with in terms of growth. And even the companies are having trouble pinning it down.
Damien, we've seen this pain in the equity market for most of this year. What I hadn't seen in credit is spreads really start to blow out. And I think that line in the sand for a lot of people in at around 500 basis points. We took that out just yesterday. How important was that?
Yeah, the question I have, Jonathan, is what is really driving spreads? Most people would have you believe that it's fundamentals. But in my opinion, humbly as it may be, it's technicals. It's secondary market liquidity. And, when secondary market liquidity is getting pulled out of the system because we have quant tightening and the Fed raising rates and financial conditions tightening, it's anyone's guess where they go. And remember, we're not talking about equity valuations where they have a floor of 0. We're talking about spreads where they can just go.
Is that a fancy way of saying stress, that you're seeing stress in the credit market?
Not quite the way I expect to, but I think we will have to before all is said and done.
Lisa, what do you make of those cracks?
Honestly, you're gonna really rail into me.
I'm just, just winding you up, just getting you going as the morning progresses.
I'm gonna sort of tarnish my brand, but usually I'm this big bear, and the wider that spreads get, and the more that yields go up, the more I understand the bull case for some of these instruments. Honestly, but you look at it, people have been complaining about no yield for years and years and years. These companies have fortress balance sheets. They're not going to have to roll over their debt in the near term. You're seeing this, and I understand the case for people who are starting to see value.
So this analysis, just to be very specific, is on a fixed income side of things,
income,
not on equity.
I'm not going to pretend
in
to know
credit or in the sovereign
equities.
space, in treasuries.
I would say treasuries are anyone's guess because we just don't know. I mean, everybody's trading off every inflationary print. But on the credit side, if you look at the fundamentals, to Damien's point, the fundamentals are not showing the same stress that the pricing is. Maybe they will, right? Because markets tend to get ahead. But this is the dissonance and the tension underpinning the lack of volatility paired with suddenly yield.
It's 2 days away and you're getting constructive.
I'm not going to go. I'm just making.
It's confusing.
I have to. Okay, let's just.
I nudged her. You can blame me.
Was that you, Damien?
Yeah.
You
agree, don't you, Damien?
Of course
Come
I do. No, absolutely. I like fixed income here. I mean, look, you're absolutely right. Relative to recent years, my God, you get a positive yield now. Go figure, right? 60-40 is back in vogue.
You guys aren't alone. We mentioned it earlier this morning. We heard it from David Stubbs, who said that bonds were back. Scott Minerd earlier this week, Lisa, as we were starting to push 350 on a 10-year. He's thinking about the same kind of thing.
Exactly. I just have to say that a listener writes in, a Twitter user, are you hungover?
Are you hungover?
Bull. There is this idea that, I have been bearish for so long, but if you're going to see suddenly yield and you're going to see an economy that isn't falling off the rails yet, you can make every argument under the sun. We don't know, but I understand.
Someone gave Bramo TK's tank. That's what happened here. Equity futures on the S&P. Drink
it's clear.
Up 0.9% on the Nasdaq 100. It might be something else. Up by more than 1% on the Nasdaq this morning, bouncing back. On the S&P this week, we're down about 6%, heading for the biggest weekly loss going back to the pandemic. It has been that bad. Yields higher by a couple of basis points, 321.62. Before we started this segment, we talked about the median year-end forecast on the south side on Wall Street. It's still 46.50. Jonathan Golub joins us now, the Chief U.S. Equity Strategist at Credit Suisse. John, great to catch up with you, sir, and thanks for coming into the studio too. You've been constructive on this equity market. It's been difficult. You can't get them right all the time. Walk me through what you're learning as this year progresses and how you're thinking about the future now.
Well, I think you guys are actually right on point. So let's start with Damien's comments. Credit spreads have blown out, but there's not a credit performance problem. And what I mean by that is, people are paying their, are making their interest payments, and people aren't going bankrupt, and companies have lots of cash, and they've termed out their liabilities, so they don't have this rollover risk. So the credit is performing as if we have this incredibly healthy economy. And yet you have credit spreads really wide. And I think one of the things that are going to drive equities higher between now and year end is if we don't have a recession between now and the end of the year, which I think is unlikely, then I think that the credit spreads actually come down because there's not a credit problem. And yet the market is pricing one. Now, there's a second issue, John, which you raised, which is so far, year to date, the market has really discounted a higher cost of capital, not a recession. And people are saying, is the market discounting an earnings problem, this, that? Not really. I would say, though, the last week, the market is starting to say it's not just a higher cost of capital or a higher discount rate. It's actually the damage that the Fed's going to do, and are we getting a recession sooner? And there, I think the debate is, it's a simple debate. It's hard to figure it out, is when does the recession start? If you think that we have a recession in 6 to 9 months, the downside from here is substantial. If you believe that the recession is in the latter half of 23 or further out, then you got to buy stocks right here because the earnings will come through and there won't be an earnings problem.
Jonathan, I wanted to go there. The range of outcomes and just how big the extremes are. I just go back to what Andrew Hollenhorst said. Volatility may prevail now that the market will reprice Fed policy based on each monthly inflation reading. How wide is your bear case scenario and your bull case scenario?
Lisa, so we actually put out a report yesterday, which was it was kind of like a wonky report for guys who kind of love market internals, and it got a lot of attention. We looked at the dispersion of analyst estimates. So let's say you picked the stock, Microsoft, and are all the analysts, clustered at a very similar outlook, or are they all over the map? The more that the estimates are all over the map, the more it tells you that people are concerned about recessionary outcomes and the direction of the economy. And we're seeing that in 9 of 11 sectors, you are below average in dispersion, meaning that there's very little doubt from analysts on the direction of profits. Now, where did the analysts come from this? It's not like they're pulling it out of their head. They're talking to company management, and company management is saying we actually have a surprising amount of clarity. Things seem okay. We're not seeing stress with our clients. Margins are under pressure, but a little, not a lot. So it was actually pretty surprising to me when we looked at the data how clean the earnings story looks, not only in terms of the earnings being good, but how there's this pretty high level of conviction on both the part of company management and Wall Street analysts.
Well, Jonathan, I think, we've seen the two main factors that are driving, equity earnings expectations, I think, are rising bond yields and higher commodity prices. So my question for you is the pace, are you comfortable with the pace of downward revisions going forward? Do you think it's going to accelerate or, are we there yet?
So if you look year to date, the earnings revisions have been solidly positive. So let's say at the beginning of this year, if you look at the 12-month outlook for earnings, and then you do the same thing today, we're 7.5% higher than we are. So the market's down, 23% or something like that. But you have a positive 7.5% on the earnings and a negative 31% on the stock multiple. So what it really says is we have a problem. Listen, you have cash flows. You discount them at a higher discount rate. They're worth less money. And it makes sense that people would say, yeah, but maybe the market's really telling you the earnings aren't good. I don't think that's the case. I think that what you have is a real downgrade to what you're willing to pay for a dollar of earnings, not the other way around.
John, we've got to finish on this. Everything you've said, is it enough to get us back towards 5K on the S&P?
I think the answer is directionally yes. I think that right now the market is really oversold. If you look at the way that how intense the daily moves are and how much volatility there is, the key is that we have to be confident that the Fed's not driving us into recession. If we start to see, for example, the next couple of job reports, if we see God forbid, a negative print where you actually have a loss of jobs or something, well, then the market's going to freak out and you're looking at much lower numbers. But look at what we've had. The ISM, which is an indication of industrial activity, well above normal. The last job report, very strong in terms of jobs. Earnings season, really big beats. So I think that ultimately the fundamentals win out. But I will tell you that the last week or so shakes everybody's confidence.
In a big way. John, I'm just going through the numbers, and I don't want to beat up on you. You're not alone. I've got Oppenheimer at 53.30 year end. You're at 4,900. Got Bowski over at BMO at 4,800. Got others, Bank of America, Savita, who hasn't been constructive, Savita Subramaniam, at the best of times, and she's at 4,500. I just wonder, as an analyst, as a strategist, John, and you look at this market run away in the other direction, what do you have to do? What should you do?
Well, we actually lowered our numbers. I don't know, about 8 weeks ago, a little bit, and when we went back to the to the pieces, we're not. The right thing to do is not to forecast a market. It's to say, okay, let's start with the earnings. Are my earnings right? Are they too high or too low? When we went back and tested them, and the earnings, if looked incredibly solid. We looked at our numbers and said, if we're going to make a change, maybe we should move them higher. The earnings were looking pristine. Some of that is more coming from energy, but nonetheless. And then we look at the multiple, and this is why we actually lowered our estimates a little while. Is like, no, you have to lower your expectations for stock multiples, for PEs, when the cost of capital goes up. Now, if we were to downgrade our number, it wouldn't be because we think that our earnings are off.
Yeah.
It would be because we say, listen, these those credit spreads that Damien was talking about before, if they stay wide, then stocks can't rebound. They have to come in.
I had to squeeze that in, John. It's good to get your perspective. Jonathan Golub there of Credit Suisse. Equities up by about 1%. Next up, we'll hear from the White House. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ruchika Gupta. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. BNP Paribas has expressed interest in a potential acquisition of Dutch consumer lender ABN AMRO Bank. Bloomberg has learned France's biggest bank recently reached out for a meeting with the Dutch government to discuss its interest. Shares of ABN AMRO rose as much as 18% on that news. Cross-border European bank mergers have been rare in the last decade as negative interest rates weighed on results and executives waited for progress on a banking union in the bloc. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The 75 basis point move I thought was a bold one. He wants to send the signal that the Fed's committed to not letting inflation expectations get entrenched in corporations and pricing. And in the meantime, I think clearly we have to do everything we can to get the supply chain open.
That was Congressman French Hill of Arkansas on a range of issues this Federal Reserve and this White House is facing at the moment. From New York City this morning, good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro, together with Damian Sassower. TK out of the building, equities higher. No correlation there, I'm sure, at 1% on the S&P 500, on the Nasdaq 100 up by 1.2. This inflationary backdrop is a big challenge to everyone in this country. It's a big challenge to this White House too, and I'm pleased to say that joining us now is Heather Boushey, the member of the White House Council of Economic Advisors. Heather, fantastic to catch up with you. You guys are taking this very seriously. The Washington Post is out with a story this morning on a range of issues, proposals that you're putting forward at the moment. One of them is imposing price controls and banning exports of U.S. energy. And I'd just like to know, first up, how seriously we should be taking that reporting this morning.
Well, certainly, as the president made clear over the course of this week, all options are on the table in terms of energy. He sent a letter this week to oil refiners to say, hey, you all need to do your part. And that was part of showing just how important this issue of inflation and gas prices is to the president. He understands that this affects the pocketbooks of American families all over the country and is doing what he can to make sure that the prices that people pay at the pump are fair, even given the fact that we are in the midst of this unprovoked war by Putin in the Ukraine that has upended oil markets, leading to shorter supplies and increases in prices. But one of the things we also know is that refiners are, there's a gap now, a growing gap between how much they are paying for the oil that they bring in and how much they are charging at the other end. That gap used to be about 50 cents. It's now over $1. And so that is one of the things that the president is focused on this week. And then, as he said in the letter to them, he is willing to use all of his powers that he has available to him to take next steps. But he wants to talk to them first, figure out what they can do together.
Heather, let's flesh some of this out and give me some time to do so if you can. I'll go through it. This is what the president said. Exxon made more money than God this year, buying back their stock and making no new investments. A quote from the president. This is what Exxon said. Globally, we've invested double what we've earned over the past 5 years, $118 billion on new oil and gas supplies compared to net income of $55. This is what the president said. At a time of war, historically high refinery profit margins being passed directly onto American families are not acceptable. He's alluding to them deliberately holding back capacity, alluding to price gouging. You've done the same. Your own Energy Information Administration has reported only recently that the industry was working at incredible levels of capacity utilization of over 94%. Your own Treasury Secretary has said it's not price gouging, it's demand and supply that's largely driving inflation. So, Heather, my question to you, and thank you for allowing me to flesh that out, is who's giving the president these talking points, because they do not add up?
Well, here's the thing. One of the things that we have seen, again, in large part due to both the pandemic and the war in Ukraine that Putin has been waging, has been there's been capacity at refiners globally has been taken offline. So over the course of the pandemic, here in the United States, about 800,000 barrels per day were taken offline. And so the president is saying, hey, can we work together to figure out how to get that back online as quickly as possible?
Heather,
Let's
I hear you,
increase
but
that
the president's
capacity.
not just doing that. He's suggesting something nefarious is going on here at the same time. That's the politics of it. I hear it. He's alluding to price gouging. He's saying they made more money than God. They're buying back their own stock. They're making no new investments. Yes, they are buying back their stock. Yes, they are also making investments as well. As I said earlier, your own Treasury Secretary says this is supply and demand. We're having a policy conversation. The president isn't. He's speaking just about politics. He's trying to make out something nefarious is happening down in Texas.
That is not true.
I've just read out all the quotes, direct quotes. Which bit of it isn't true?
It is not true. The president is having a policy conversation. He is looking at the data and the evidence in front of him about what is happening in this industry. And what you cannot deny is that the last time that oil barrels were priced at $120 per barrel, gas prices at the pump were about $4.25. Now, at this same price level, of course, it fluctuates every day, but now at this price level, you're seeing prices at the pump of over $5. There is a gap there, and this is what the president is focused on. That doesn't, obliterate anything that has happened in between, and yes, certainly investments have been made, but the president is saying, what more can we do?
Yeah.
Because we need to get this oil supply to consumers at this moment. People can't very quickly change their demand for gas. People need, drive their cars to get to work. So he is focused on what else the refiners can do. And there is evidence that they are bringing in exceptionally high profits, and that there is this gap between the prices that they are paying and the prices that they are charging that is larger than before. So that is all evidence, and that is still about supply and demand.
Well, but Heather, let's say you cannot get that supply on in the way that the president would like in the short term. How worried are you about essentially going against what the Fed is trying to do with dampening demand by things like rebate cards or subsidizing the prices of gas and other goods at a time when the Fed ultimately is trying to get demand to come down?
So that is such a great question. You've elevated how this particular economic moment is very tricky because we have so many supply side challenges. As Jay Powell himself noted, the Fed's tools are blunt and they are essentially on the demand side. But we have these, and we've seen them over the past few years, these incredible supply chain snarls. We're seeing these challenges in large part because of the pandemic. And so that is why the president has had a multi-pronged approach to figure out all of the different ways we can attack where prices are too high for consumers.
We don't have a lot of time left, but just quickly, the point is that it's very hard to deal with the supply chain disruptions, and it takes time. So without that really getting remedied in the short term, why is it good not to just see demand come down a little bit?
Well, certainly that the president is letting the Fed do their job. But, so yesterday the president signed new legislation on ocean shipping. Here's a place where that legislation and the work that the Federal Maritime Commission is doing right now could have an impact on prices that consumers pay for goods that are being shipped from overseas. So the president is doing everything he can to lower prices using all the tools at his disposal and trying to work with Congress to do so.
Heather, I promised I'd let you go at 8:25, and there's 5 seconds left, so I'm going to do exactly as we promised. Thank you for catching up with us today. Heather Boucher there of the Council of Economic Advisors. Lisa, this is a really, really sticky one. It's an incredibly sticky one. And the president, and of course Heather Boucher's got a view on this, a perspective. And we gave her the time to say what she had to say. But what he's saying and the facts sometimes on this do not stack up. You can't reconcile the facts with some of the things he's saying. For one, the investing, can't reconcile it. With the price gouging, their own Treasury Secretary is saying it's not price gouging. At the same time, they're going around saying it's price gouging. So something's going wrong there.
And there have been a lot of different messages, and they aren't necessarily always cohesive. President Biden has a difficult moment. There also is this recognition that there are certain things they don't have control over. The speed is what I'm concerned about.
Equity futures right now up 1% on the S&P 500 from New York City this morning. Good morning. This is Bloomberg. Live from New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. Tom Keene out of the building. Damien Sasser into the seat. Equity futures look like this on the S&P. On the Nasdaq, we're positive by more than 1% on the Nasdaq 100. On the S&P, just short of that level, up 0.9%. Yields up a couple of basis points, 321.62. I want to jump straight to this conversation with Drew Matters, who's going to give you a different perspective of things. Chief Market Strategist of MetLife Investment Management. Drew, you think this Fed's getting it wrong. That's not new. A lot of people see it that way. You think they're getting it wrong for different reasons. Can you run us through it?
Yeah, I think whenever you're talking about the Fed containing inflation, right, the thing I hear is they have to do it. They have to contain inflation. It's their imperative, and they have to do whatever it takes, including a recession, to get us into a lower inflation environment. What I think people miss is that there's always a trade-off between growth and inflation. And we know how to solve the inflation story. We saw that actually in March of 2020. You can just shut the economy down, inflation will come down. Right. So really, the Fed's job is to manage inflation lower in a way that causes the least amount of damage to the economy over time. And I think in this case, by not really getting investors to think about core inflation and not taking the signals that longer term inflation expectations from professional investors are giving them, they're actually rushing ahead to solve a problem that can't be solved by their interest rate hikes.
Drew, there's a debate right now of what's causing inflation. There are a lot of debates, and there are a lot of unknowns, but one of them is this more demand-driven and more supply-driven? The president is saying this is largely supply-driven and pushes back on the demand-driven side, saying it was not necessarily the stimulus checks that were sent out last year. Are you also saying this is completely a supply issue, not a demand issue, and has to be entirely fixed on that end?
No, it's both. It's both supply and demand. There are clear supply chain problems that are creating inflation pressures, but there's also a demand story. And so really what the Fed should be saying is we're not targeting 2% inflation because 2% inflation is in a normal environment where supply chains are functioning. We are targeting core inflation, so absent food and energy, because we can't control food and energy prices. And we believe this portion of inflation is due to supply chain issues, which we're also not going to solve with interest rate hikes. And if they did that, if they recentered the conversation, they could stop worrying about credibility. They have credibility. If you look at five-year inflation expectations, you look at longer-term inflation expectations, the market believes the Fed is going to strangle inflation. They're going to stop it. It's going to end, and it's not drifting into the longer end of the yield curve. By continuing to say that you can stop inflation now, whip inflation now, right? It was the old comment, and it's a shame Tom's not here, or else I would have gotten him started on something. But if you keep focusing on shorter-term inflation pressures you can't control, you will lose credibility because no one believes that you can do that.
So, Drew, let's say that they go ahead with what they've said that they're going to do and try to dampen demand to offset the lack of supplies or some of the supply chain disruptions. How bearish are you? I mean, do you basically think that this will be a Fed policy error, the likes of which we haven't seen in decades, and will cause you to hide out in cash?
There's been a series of Fed policy errors this cycle, and I think the main one really, and a lot of people have alluded to it on your show, which is, they just didn't start soon enough. They knew there was a problem, and instead they continued quantitative easing. They continued hiking rate or lowering rates or keeping rates low when they could have moved earlier and the market would have accepted it and actually appreciated it. And instead they waited, and now they're trying to play catch up. And there really is a difference between doing a series of 25 basis point moves over half a year or 3/4 of a year and trying to get there all at once. It's not a linear movement in terms of the market response to 25 basis points, 325 basis points moves versus 75. And I think that's why you're seeing the market behave the way it is because the Fed seems a little disjointed here. They told us 50, then all of a sudden it was like, oh no, we're going to go 75 after they ruled out 75 the meeting before. Nothing really changed all that dramatically. There was a slight uptick in inflation expectations on one survey. So it doesn't really justify the kind of swings we're seeing in Fed policy. And I think that should probably make everyone nervous.
Drew, last month's Fed minutes, it flagged the potential hit to U.S. Treasury liquidity due to quant tightening. And, here we are. We've got $522 billion of runoff expected between now and year end. There's been a widening of bid-ask spreads in the 10 and 30-year tenor. And next week, we've got $160 billion of Treasury auctions coming. What are you looking for there? What's your confidence in dealers' ability to intermediate in the Treasury market?
I'm not actually overly worried about that at this point. I don't think we've seen a lot of movement. Quantitative tightening is going to happen over a very long period of time. It's not always going to be pushing more supply into coupons, right? A lot of actually what's going to roll off, what the Fed's going to allow to roll off, is actually going to get pushed into bills, where there actually is a kind of a decent demand for them. And so I think as we look ahead, the real impact of quantitative tightening it should be to actually lower inflation over time. And I know it's kind of out of favor to look at the size of the Fed's balance sheet and look at inflation. But if you look at it historically, there actually is a little bit of a relationship there, a little bit more than you would imagine, given the fact that people really don't like the MV equals PQ equation, money times velocity equals nominal GDP. People have kind of said that doesn't work. If you really dig into the balance sheet, there actually is a little bit of a relationship there. And so you have to wonder, what's actually been causing this inflation pressure. Yes, it's the government sending checks out. It's the increased demand. But at the same point, there's clearly, in my mind, a balance sheet component to it. And as we move that back towards normal, that should alleviate some of the problem.
Drew, you mentioned Fed credibility, and I just have to ask this question. 75 bips, do you think they actually gained credibility by going 75 bips to fight inflation, or did they lose it because they clearly flagged 50 bips? I'm just curious to hear your thoughts on that.
I would say it wasn't helpful. I would have, they had laid out a path of 50s. Extending that path, I think, in my mind, would have been more reasonable. One of the ways we look at Fed credibility is the relationship between real assets and financial assets. And up until a few weeks ago, they were actually doing quite well, historically speaking, in looking at that relationship. And as of late, that relationship between those two, the relative value between those two has been shifting, which suggests that kind of the recent Fed movements are not well understood by the market to actually be supportive of kind of a longer term, limited inflation dynamic. At the same point, though, five-year inflation expectations continue to stay low. And that is really what they should be hammering, which is we cannot contain food and energy inflation. And historically, we've never tried to. But what we can tell you is that inflation is not going to be this high once we get through this period. And define the period or not, it doesn't really matter. But telling people that you can affect inflation now is probably not great. I took some comfort from the economic projections. I know a lot of people don't think that they're all that reasonable, but if you look at their core PCE projections, core PCE has been coming down. They have core PCE continuing to fall in a way that's I think realistic. And so, it's still going to be above 4 at the end of this year, according to them. But I think if they were to kind of take a step back and say, hey, you know what, we target 2, we're willing to accept 2.5, and we have a supply chain dynamic that maybe means it should be closer to 3.5. It really would suggest that they're actually getting much more momentum towards their goal. And I think it would comfort people to understand that there is a stopping point for the Fed.
Drew, just quickly, your analysis is a little bit different. We started the interview that way. You provided that analysis for us. Can you tell me how your investment approach is different? What's the big market call that sets you apart as well?
Well, so we live in the same world that everyone else is in, and so there's a big inflation component to it. There's a weakening growth story. The retail sales numbers, which got completely ignored, but which were, in my opinion, one of the worst things that I've seen in a while. There are all these signs that growth is slowing, and you have growth slowing, you have inflation rising, and when you look at that, certain assets tend to do better. MetLife is a big real estate investor. That's helpful for us. We're also big ag investors, helpful for us. And then, of course, there are opportunities within credit. You just have to be careful.
Do you have to be careful in real estate right now, Drew?
You have to be careful everywhere. I mean, we're in an environment.
Particularly real estate facing the mortgage rates it is right now. It's pretty brutal.
It is. But that's actually another kind of interesting point you bring up. You're raising rates, so you're raising mortgage rates, so you're pushing more people into renting when we have an issue with rental demand. And so, once again, just because you're hiking interest rates doesn't mean everything you're doing is going to help contain inflation.
Drew, wonderful final point. Drew Mattis there of MetLife Investment Management. And I can tell you repeatedly in the commercial breaks for the last 3 hours, that point is the point that Lisa Abramowicz has been making repeatedly.
Well,
Lisa, you're thinking about that a lot, aren't you?
Well, because if you look at the CPI components, this is one of the biggest components is rents. And if you start to price people out of the mortgage market, you price people out of home ownership, that keeps them in the rental market. It actually jacks up rents even more. And to Drew's point, he's talking about this, they're buying up properties because they can raise the rents. I'm not saying he's going to raise the rents, but that's a steady source of income that can be pretty sticky considering the lack of supplies that we're getting in the housing market.
Will you write a column on this for us this weekend?
Don't get ahead of me. Yes, you're going to try to front run me. Yes,
no, good. That's exciting.
Yeah.
I'm looking forward to reading that.
Thank you.
On the plane, away from here. Lisa, thank you. And Damien, thanks for jumping in the seat as well.
Thank you.
We appreciate it, mate. Just fantastic. Final call from you. Rory, does he get it done on Sunday?
You know, I just have to ask you this question. It's really for Lisa. You know, Lisa, you're here every day, 5 days a week, 3 hours a day, and not once do you ever try to speak in a British accent? Just a little bit, Lisa.
How much money are you getting paid for
that? A little bit.
Seriously, are you trying to?
I gave you the floor to make a golf call, not to come after me. And the country.
What? I would never do that. Jonathan, never. Come on.
Coming up in the next hour, away from these two, Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College Cambridge president on Bloomberg TV at 9 a.m, counting you down to the market omen. David, thank you.
Thank you, Jonathan.
Awesome. I think I called it the market omen and not the market open then. Make of that what you will. Futures on the S&P up 0.8 to 1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will convene world leaders from roughly 24 countries in a summit today focused on propelling the fight against climate change. The virtual summit is on track to be the largest gathering of world leaders focused on climate action ahead of a critical United Nations summit in Egypt this November. Biden will highlight the war in Ukraine as evidence of the need to accelerate the clean energy transition and bolster food security. A cross-asset sell-off for the ages is shaking the conviction of money managers around the world, yet Cliff Asness remains steadfast in his belief that value investing can keep winning as the quant strategy notches heroic gains in a year to forget on Wall Street. The co-founder of AQR Capital Management tells Bloomberg there should be more gains to come.
So we are still kind of maximally excited at value. You know, a year and a half ago, you had to say, damn momentum, I'm ignoring it, this is ridiculous. You now have something that's not quite as ridiculous, but something I didn't think we still have prices I didn't think I'd see again in my career going on now. So we love value still going forward.
Sweden's Riksbank has named a new governor. Stefan Ingves will leave the central bank at the end of the year after 17 years of steering monetary policy in the biggest Nordic economy. He will be succeeded by Erik Thedéen, who now heads the Swedish Financial Supervisory Authority. The news comes as the Riksbank has made a momentous policy shift. The central bank is addressing a surge in inflation and is under pressure to speed up rate hikes it flagged back in April. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We've underestimated inflation. A large part of why inflation has been revised up, our forecast has been revised up through time, has been the incidence of these new shocks. Shocks by nature we couldn't anticipate. Monetary policy just cannot respond quickly enough or have an effect quickly enough to bring inflation down in the short order.
Hugh Pill, chief economist at the Bank of England, after them raising rates by 25 basis points. The expectation was potentially for a 50 basis point rate hike. Damien Sassower is putting on a British accent here alongside me. Lisa Abramowicz, Jonathan Ferro off to his next property. Tom Keene having a nice extended weekend. We've been talking all week about the pound and how weak it is and how it really is between a rock and a hard place for the Bank of England. And then someone comes out after writing a book with incredible expertise on the history of crises in England, and that is no one other than Sir Howard Davies, who is chair at NatWest Group and author of this book, The Chancellors. Sir Howard, when did you start writing this? I mean, honestly, it comes at such an amazing time of crisis where people are looking for history and anything as a guide.
Yeah, well, it was a lockdown project. I felt guilty in the lockdown. I had to use somehow the time that I was saving. So I thought, well, maybe it would be a good point at which to reflect on the history of the last 25 years, which has been pretty exciting in the UK. You know, we had the great financial crisis, we had Bank of England independence, we've had Brexit referendum, Scottish referendum. And I asked the various chancellors who'd served through this period if they were prepared to reflect on it. And of course, they had time on their hands as well. So in fact, they were very happy to talk to me about it, as indeed were quite a lot of officials. So what I've tried to do is to tell the story of the last 25 years as seen from the Treasury, which turns out now to be quite a relevant thing, I think.
Sir Howard, we were talking earlier this week about how the Bank of England raised rates because they were concerned, they raised rates only 25 basis points because they were more concerned about the labor market softening or perhaps consumer demand getting crimped in discretionary spending than they were about the inflationary inputs that continue to create huge pressures on the economy. Was that the right move based on all of those conversations you had?
Well, I think I was with the three in the minority. I mean, it was a 6-3 vote on the Monetary Policy Committee. Interestingly, of the 4 external economists, 3 voted for a 50 basis point rise and 1 voted with the Bank of England insiders for the 25% rise. And I was with the 3 out of the 4 externals, I have to say, because I think one of the problems that we have, and you just referred to it, is that the weakness of sterling is contributing to inflationary pressures as well. And if you look back at the experience of oil prices, and one reason why we're now facing a £2 a litre diesel price is because the pound has slipped down to 120 something. And it's not long ago that we were at 140. So we are making our problem more serious by the fact that sterling is weak. And I think in part, that is weak because of the perception that rates will not rise as much here as they're going to rise in the US.
Sir Howard, you rightly call out central banks for openly claiming that they can't tame inflation. But in reality, they can. I mean, they have a blunt tool. They can raise rates, choke demand, and drive an economy into recession. My question for you is there any way that central banks can do that without driving an economy into recession? Are there other policy tools at their disposal, or perhaps it's not providing as much forward transparency? I'm curious to hear your thoughts on that.
Yeah, I think what's one got to look at is the time dimension here. And obviously, if you get a very sharp exogenous shock, like an oil price increase on the sort we've had in the war, then you can't expect central banks to deal with that instantly. But in fact, the inflation target formula explicitly recognizes that. And inflation targeting is meant to target an inflation rate at 18 months, 2 years ahead. So I think whereas I can accept the central bank saying, look, we can't respond to this immediate spike, that's fine, that's understood. But what they must do is present a plausible path of interest rates, which is going to deliver them back to the inflation target in 18 months to 2 years' time. And that's why I think you need a higher rate at the moment in order to give credibility to this medium-term inflation outlook. And I don't think that's where we are at the moment, unfortunately, in the UK.
Well, Sir Howard, let's tear up the script a bit. You've been a member of the International Advisory Council for the China Securities Regulatory Commission since 2003. There's about 200 China listings on U.S. exchanges, I think roughly 1.7 trillion in assets. With all that's going on, with the lack of transparency with the PCAOB, I'm just curious to hear your thoughts on that. I mean, what is China's approach to all this? Do you think companies like Baidu, JD, I mean, are they going to avoid having to delist in the near term?
Well, the Chinese approach is evidently changing. Up to now, the CSRC, the Chinese equivalent of the SEC, if you like, has had a general policy orientation towards opening up Chinese markets. They've established a link between Shanghai and Hong Kong, a link between Shanghai and London, and that's been the direction of travel. Now, there are, however, signs recently, as you say, of the Chinese wishing to pull back because they're unhappy about the influence that external regulators have via a Chinese company listing in other markets. I think it's very difficult to say at the moment where this is going to go. And of course, for the last 2 years, COVID has got in the way of direct connections. I remain on that advisory council. In fact, I'm chair of it, but we haven't actually had a physical face-to-face meeting, and it's in the face-to-face meetings where you really understand what's going on. So I'm not trying to avoid your question, but it's honestly quite difficult to answer in circumstances where you haven't actually met people for well over 2 years now.
Sir Howard, before we let you go, do you think that the pound is ever going to get above that 145 mark versus the dollar that we saw pre-Brexit?
Unlikely would be my guess. I can't quite see why. There are the short-term issues we've been talking about involving interest rates, but also in the longer term, we do have a structural trade deficit, and that's been offset by capital flows for a long period of time. But, you can only sell the London property market once externally, net, if you see what I mean. They can trade it amongst themselves. You can only sell it once. So I don't see quite what is going to push the pound up.
Sir Howard Davies, thank you so much for taking this time, and congratulations on writing this book. I do want to bring you some headlines from Fed Chair Jay Powell, who has been speaking, saying that the Fed is acutely focused on returning inflation to 2%. But Damien, I was struck by him saying that the dual mandate hinges on ensuring financial stability. Is this code for saying that they are starting to get concerned about some of the liquidity concerns that you were talking about earlier?
Well, I think they've been concerned about it. I think he's hedging. I mean, look, what we're talking about is policy optionality, flexibility, something that Chair Powell really just hasn't been very good at to date. So, for me, that's what we're looking for. I'm sure it's a step in that direction. Meanwhile,
we are looking at something trying to be a rebound, although fading through the morning. S&P up 62, 36.93. Nasdaq up 0.8%. You could see Treasury yields just edging downward a touch, especially on some of these headlines. Coming up in Balance of Power, Steve Ballmer, owner of the Los Angeles Clippers. This is Bloomberg.